Ladies and gentlemen, welcome to the Coreweave earnings call live stream. We're not just going to be talking about Coreweave. We also have many other names that we'll discuss between 4 and 5 p.m. as earnings come out. There's plenty of companies that we're going to be talking about today, but it's not just me. I'm also joined by some amazing co-hosts. Jose Najarro, how you doing, brother?
Pretty good, pretty excited. I know we'll talk about it, but it's a crazy day. I feel crazy, like you mentioned.
Yeah, I was saying, I was like, dude, this NVIDIA sell-off is blowing my mind. And we're also joined by the great and powerful couch investor, Neil. Neil, how you doing?
Hello, folks. How are we doing today?
I'm here for Neil. There's a lot of Neil in chat.
And I leave the market for a couple of days to chill out. I have to come back to NVIDIA blowing the market out of the water, and then the stock goes down 5%.
Crazy. You weren't with us yesterday, so I'd love to hear your thoughts first on the actual NVIDIA quarter, and what do you think about the stock reaction?
I mean, you know what was funny? First of all, Jose said I have to take a nap and then join you guys later. My nap took 14 hours. Amazing stuff. But the beat for the quarter was not surprising. The next quarter was, that was crazy. So the stock went up, and then I was like, you know what? Wouldn't be surprised if we see the usual sell-off. And I guess up until the market opened, stock was still green, 1 or 2%. The market opened and I don't know, decided that the quarter, the guidance, the comments by Jensen was not good enough. And so we are down 5.6%. I mean, they're down 5.6% on such a big beat. Imagine what would happen if they missed by like a cent. Thing would be down 50% or so.
Yeah. Imagine if guidance came in at like 73 billion. Oh my gosh. We'd be selling off.
Yeah, no, it doesn't make much sense. And I read some things that the market was secretly already looking for something closer to 80 billion. And so when the number came in, they were not. I was like, what are these silly excuses?
Secret society.
Yeah, the whisper number they said was it didn't beat whisper number. I was like, bull crap. What are we talking about?
Yeah, I saw an analyst that I forget his name, Patrick Moorhead, I think I forget his but he mentioned it actually did beat whispers. He was shocked. So unless there's whispers on the whispers that they didn't beat that.
That was my understanding, is there wasn't a single analyst that actually ended up guiding above 77 billion for earnings guidance. So this cleared all of their expectations. But of course, after the fact, you know, hindsight's 2020. People like to come out with the reasons as to why this happened. I think the only thing for me to do is just realize how unbelievably real this market is. And we're about to see one of the great beneficiaries of, NVIDIA's quarter and the amount of chips that they're actually selling. One of the core customers, well, not in the big four, but in sort of the B team, is Coreweave. Sort of the leading of the B team of customers that NVIDIA has. Coreweave is the company that we're going to be paying attention to today. Earnings are expected to come out at 4:05. Along with Coreweave, we have Rocket Lab, SoundHound, Dell, Duolingo, MP Materials, Block, Copang, Figure, SMR, Intuit, Zscaler, Marathon Digital, Energy Fuels, TeraWolf, which also might be quite exciting, Monster, Sunrun, Rocket Companies. It is an absolutely packed day today. I'm curious if you guys are paying attention to anything other than Coreweave in tonight's list of companies. And if you can disclose as well, do you have any shares in any companies that are not, past Coreweave, as well?
For me, Devin, no, I think Coreweave is the only one I'm looking at. It is my second biggest position in my overall portfolio. There's only 3 positions that have made it to like the 6-figure number, and CoreWeave is in there. So I have to pay attention. This is all I'm paying attention to right now. But obviously a company that's heavily volatile. So we're just at $70 just like 2 months ago. But still, I'm pretty excited. I do agree. This might be one of the leaders, at least in spending in the B team of like the AI infrastructure that we're seeing right now.
Neil?
Yeah, I mean, surprising enough, or maybe not surprising enough, but Coreweave is up 24% year to date. Nebius is up, I think, also 15% year to date. So it's funny to see that these types of names are outperforming a lot of the, let's say, bigger peers or even the market right now. Very, very interesting. So Coreweave, of course, I'm a holder. I own Coreweave, I own Nebius, still own Iron. I am I'm trying to think in what language I should say. I'm a bag holder of Duolingo because, I mean, that thing reports later today as well. Rocket Lab is another one I own. This thing, I mean, I first bought shares at $4 and now we're at, I don't know how much. So I'm enjoying the ride with this one. But that's about it. Coreweave, Duolingo, Rocket Lab in order would be, well, amount invested wise would probably be Rocket Lab, then Coreweave, then Duolingo, but we are going to focus a lot of our attention on Coreweave because I do think that it can have an effect on the other neo cloud stocks. I just hope there's no delays. If there are no more delays for them, I think we should be fine.
Yeah. Another one that's happening today is I don't know. I've kind of read a little bit about it. InnoData. It became kind of like a very popular in the data center AI machine learning space. So that one I think reports today. I don't know if you mentioned that one, Tana, but
I did not mention it, but I just put it on the list.
Yeah, it's a very small. I think it's like a $1.3 billion. I don't own it, but it's one that I hear people talk a little bit about, kind of like the tailwinds due to the AI market.
We also have not Goldman Sachs. Goldman Sachs BDC, Flutter, Clover Health as well. Amit will probably be listening to the earnings call for Grindr. That's today as well, so he'll be listening to that one. But we'll be paying attention to Coreweave, which also Coreweave, TeraWolf. We end up getting to see a little bit more CapEx guidance, hopefully for full year. You guys know Coreweave much better than I do. I'm not actually a shareholder of Coreweave, but looking extremely closely. It's one of those discussions internally where I'm like, do I diversify and buy Coreweave and Nebius, or do I just triple down on Nebius? But I do know that I want, some of these more AI native neo clouds.
I mean, you're in a, I guess, lucky-ish situation. If you get the information that you want, but the stock goes down, you get to buy Coreweave at a cheaper price tomorrow.
It's a good market.
And if not, then I guess you'll pay a small premium tomorrow. Although, I don't know, this earnings season doesn't matter if they report good numbers or not. Plus the fact that the stock is up to slightly flat right now is very, very suspicious. We've seen that before, but we'll see. We'll see what happens with this one. They definitely had a lot of things going against them, whether it's stock or business-wise. So we'll see. Again, as long as there are no more delays and the backlog looks nice, should be fine.
Yeah. By the way, we just got big. This is huge news. There is now officially, and I apologize for bringing this up because it's not actually huge news, but protein Doritos. Protein is taking over everything. I guess cheese, whey, maybe they could figure out to make it work, but oh my gosh. You can buy every single product and then a protein variation of that product now, I swear. I don't know how that fits into data centers, but that just came across the desk.
It's the illusion of choice. It's like the washing products. You can buy this thing and then the plus and the platinum, and it's all doing the exact same thing. It's BS. But hey, Doritos plus protein.
Yeah. At least we have that. Are there specific numbers that you want to see come out? Like what should new Coreweave investors look for whenever this print ends up coming out? What are the KPIs that Jose and Neil are looking for? Neil talked about the delay, because I think that happened last quarter or the quarter before, where they said that there might be a slight slowdown on one of their data center builds.
Yeah, so if there is a delay, that means there is going to be a delay in recognizing revenue, which means there is also a delay in money coming in, flowing to the bottom line. What there is no delay in is the interest that they still have to pay. So if there are more delays, well, the interest that they have to pay still exists. If they don't have the money to pay that interest, well, they'll have to raise money, and it creates a very bad, vicious cycle. So no more delays, things come on time, they generate more revenue, that goes down to the bottom line, and they can pay off whatever they need. That to me is the most important part, because it still is early days. Yes, the backlog is huge, but there are all of these neo clouds. Actually, at the end of the day, it's nice to have contracted power, connected power, this and that, but the most important thing is to make sure that you start generating revenue as soon as possible.
Yeah. And for me, I'm definitely interested of any delays. Even without the delays, I think we're expecting around 240 megawatts of active power to come in. And just a clarification, right? Active power is when you have the data center, when you actually have the GPUs plugged in and it's ready to go into full revenue. It has everything's locked in. And just to put into perspective, right, the sizes of this company. Nebius ended the year with 170 megawatts of active power. CoreWeave is adding that in a quarter without delay. So that's it, just to understand the different sizes of these players here. CapEx, I think, is going to be crucial. We saw for this year, due to the delays for quarter four, was going to be about, I think, $15 billion in CapEx. It's going to be that guidance, right? I mean, Nebius went from like 4 to from 6 to almost 20. Is CoreWeave going to go? Where are we going to go here from CoreWeave? From 15 to 30 or something? And how is the market going to react to that? Is it going to be punishing it for all right, you have all this interest expenses. How are you going to be able to pay that? So I have a little bit of fear and just the CapEx in the short term of how the market might react to that. So I think active power is good, because that's the one that's actually generating revenue right now. What are they guiding for next quarter in active power? And just like Neil mentioned, the delays. Is this something that is it over, or is the delay that they promised was only going to last one quarter? Is it good to go now? And how is that going to progress for the next quarter?
Right. So if I'm reading this correctly, they said they anticipate to end 2025 with over 850 megawatts of active power. Interesting.
By the way,
yeah,
market
originally was going to be a gigawatt, but with the delay, I think it dropped down to that 850.
Real quick, Jose, the market just officially closed. I don't have a bell. I've got a water bottle though. Maybe that
nailed it.
That water bottle is worth less than 15% today.
Yeah. This water bottle's losing value quickly, but I'm not going to change it out even if the company goes down to zero. Let's go ahead and see what's moving in after hours. We have Intuit up 1%. We're all going to be looking for numbers. I'm going to leave it to you guys to get the CoreWeave numbers, but I'm going to try to get anything other than that for today, like Rocket Labs. Intuit, numbers are already out. Beat on EPS by 13%. They were expecting $3.68. They saw $4.15 expected, or they were expecting $3.70. They got $4.15. Beat by 13%. Revenue ended up beating by 3%. Double beat. That's the numbers that I have right now. Stock is down. Let's see. That's the only number I have right now. Maybe it's something to do with guide. Duolingo down 9%. Neil, you're going to be learning bag holder in even more languages.
Oh no, senor. It's strange because we already had the preliminary results for Duolingo like a month or so ago. So I guess they added more information that the market did not like at all.
Oh my gosh. Well, it might be a slight recovery here, but who knows? Autodesk up 4.5%. I don't have numbers on these companies just yet. NetApp, do I have that on the list? NetApp up 5%. Earnings came in with a beat on EPS by 3%. $2.12 came in. $2.06 was the expectation. Revenue expected $1.7 billion. They got $1.71 billion, beat by 1%. EPS up 11%. Revenue up 4%. Autodesk, where is Autodesk? Down 1.8. Another double beat. EPS is up 24% year over year. Revenue is up 19% year over year. Stock is slightly red in the after hours. I think CoreWeave is expected at 405, if I'm not. Sunrun is running. That is not a name I would have thought, based on the earnings that we've recently seen, that they would be up 15%. That's crazy. I don't have numbers on them yet. People are saying XYZ in the chat. Let's see. Rocket Lab is
CoreWeave is a while. Some people are saying 405, 410.
Okay. My report says 405, so we'll see. But then again, my report said yesterday that NVIDIA was going to put their earnings out at 420. So you saw where I was going with that.
That was such a long 2-3 minutes. I don't know how long it lasted, but for like 5 minutes, we were just all quiet, refreshing.
Dude, it was 15 minutes. It was 4:33
Was it that long?
or something. Meta, a report just came out from The Information. Meta's internal chip design efforts hit roadblocks. Ooh.
I'm guessing that's why. I guess we saw that Meta and AMD deal, which kind of was like a custom GPU. I wonder if that's to help offset that a little bit.
They had a candle wick that was red for a little bit, but honestly, that's why NVIDIA's here for you, baby. You don't need to worry about all that. You can just pay a little premium. You get your chips to the finest of quality for a high price of 75% gross margins. But I still don't have numbers on Duolingo. Numbers, okay, that's weird. It's a double beat, looks like.
Yeah, but the Q1 guidance.
Oh, dude, they're down 20%. Neil. Okay, tell me about this. You saw their guidance already?
Yeah, I sent the link in the private chat for the Wolf recap.
You are always so quiet.
I know.
Yeah.
Silent killer, just like Duolingo.
Revenue ended up missing for next full year guidance. Instead of 1.26 billion expected, they're now expecting 1.21 billion. Bookings of roughly 1.28 billion versus 1.4 billion expected, roughly. It's not looking great for next quarter or full year. What do we think about Duolingo here, now down nearly 21%? Anything new?
I don't even want to talk about Duolingo because I feel like that energy is going to come to CoreWeave.
No,
nice.
Because there is a difference, because Duolingo themselves, last quarter, what the main reasons why the stock completely crashed is because they prioritize growing users and less on the monetization side of things, which is why we're seeing this miss for next quarter as well and for the full year. Which is why I'm surprised the market is as surprised as it is right now, because they literally told us we are going to focus on growing the user base and less on monetization. If they can grow the user base, eventually monetization will follow, because monetization has been working for them. I guess the market just doesn't trust the strategy just yet, because Q4 daily active users still grew 30% year over year. Paid subscribers up 28% to 12.2 million. So that was fine. Free cash flow seems to be fine, which is why they now have a $400 million share buyback program. I guess every company which stock is down 60% or so and still is very profitable, I guess they can take advantage of that. But yeah, I guess I'll have to listen to the earnings call later to see why the market is as surprised, what the messaging is there. But yeah, I'm not that surprised.
I always find it funny when the company gives you preliminary results that are bad, and the market's like, no, I don't think they're that bad. I'm not gonna trust you. I'm gonna price in something better. It's like we literally told you it was.
Dude, we are getting some crazy results right now. Soundhound was expecting negative 10 cents of EPS. What they actually came in was 10 cents of EPS. Essentially a 200% beat, if you want to call it that.
Yeah, I don't trust that.
Was there a one-time fee or something? Was it a one-time gain or something? Did they sell something?
Considering they're down 1%. But I'm also seeing revenue beat by 2%. Which was up 59% year over year. Zscaler as well just came in. Zscaler, another double beat, 12% beat on EPS, 90 cents expected. They brought in $1.01, and revenue slightly beat by 2%, but still up 26% year over year. And I also wanted to touch on really quickly Dell. Dell is up 7 freaking percent. EPS came in at $3.89. $3.51 was the expectation, beat by 11%, and EPS also beat by 6%. They wanted $31.6 billion. They got $33.4 billion. Revenue up 39% year over year. EPS up 45% year over year. Can I do one more? Rocket Lab. Rocket Lab, they were expecting negative 10 cents of EPS. They got negative 9 cents. EPS, revenue, 178 million was the expectation. They got 179 million. So EPS beat by 10%, revenue beat by 1%. Revenue is up 36% year over year.
I just sent you Coreweave on X too, or on the chat here.
Oh, okay. Speak to it, please.
Well, revenue was a beat by about 2%. Market was expecting 1.5 billion. They gave 1.57. Earnings per share, though, was a miss of 30%. Earnings per share was expected around 68 cents, a loss of 68 cents. They gave a loss of 89 cents. Yeah, so they're out. I'm going to take a closer look at that, but I haven't seen the stock price.
Real quick, Block's up 20%. Report just came out. They're cutting 40% of their workforce. 40%.
So this is what I should be expecting from PayPal.
Oh my God. You know what's crazy is the other quarter they spent like $63 million on like a big work party. I guess it was a going away party. Oh my gosh.
40%. Well, okay. I guess Jack Dorsey has learned something. Finally.
Yeah. You're fired. Seriously. Oh my gosh. Okay. I did say yesterday, Block could be quite a surprising company. They've been seeing a lot of actual website traffic recently. The amount of downloads has spiked on their company. Didn't expect them to cut their workforce. So CoreWeave's down 5. What the heck happened? Let's go through this report.
Some cool things from the report. They mentioned they added the 260 megawatts that they were expecting to add, bringing it to 850 megawatts. They did expand their total contract power to 3.1 gigawatts. I think that's roughly what Nebius is also looking for by the end of this year. Partners of choice, they announced some pretty cool players: Cognition, CrowdStrike, Cursor, Mercado Libre, Midjourney, and Runway as some new enterprise and AI pioneers.
Wow.
Let's see. I'll keep a closer eye, but if you guys see anything else from there. Revenue backlog, $66.8 billion, up from the, I think, 50 billion, 55 they had last quarter.
More than 4 times when we where we began the year was their backlog. That is crazy.
Yeah, that makes sense. Let's see. Cool.
Mercado Libre in Cursor, CrowdStrike. These are some huge names. Okay, so why is it being brought down then? Is this lower than expected, or is this just a CapEx? So EPS missed slightly.
Yeah, I'm gonna guess it's that EPS miss. We don't have any. They don't share CapEx guidance until like the earnings call where they release a next slide. So I wonder if the CapEx story is still not being told. But outside of that, I think it was as expected. Earnings per share, but I'm going to have to guess it has to do all with just timing of when they purchase something or when they do something that creates a very high flexibility or volatility in earnings per share.
Yeah. Holy.
Interesting.
Dude, I'm trying to get over this block number here. This is pretty crazy. They're up 20% on cutting 40% of their workforce. Rocket Companies is also up 7.5%. Oh, by the way, Block's actual earnings that came out, nothing interesting at all. The revenue in line, EPS completely in line. EPS is up 38%, but revenue only up 4% year over year. TeraWulf, that looks like a huge double miss, down 2.4%.
Is TeraWulf a pure shell company, power shell company? Do you know, or are they also trying to do the GPU rentals?
I know zero about Wolf. They have a huge miss though, and that's not being reflected in the earnings. So there must be something that I'm missing here because revenue missed by 19% and EPS missed by 130%.
Jose, I guess the Coreweave adjusted operating income and margin miss is just because of the delay.
It would have to be, right? Yeah, because I mean, if you slow down the delay there, you're gonna get that revenue, so you're gonna take a margin hit on when that money you spent. But I'm gonna guess that's gonna be a question during the call. It also did seem like they expanded their revolving credit to 2.5 billion, and they raised about 2.6 billion in convertible senior notes.
Rocket Companies. Where did that company go? I thought I had it on the list. Rocket
Companies?
Yeah. Rocket Mortgage, Rocket Companies now. Up 7.6%, double beat. Revenue is up 106% year over year. That beat by 6%. EPS is up 175%, but beat by 22%. That's a huge double beat. And most likely probably even raised guidance based on just alone how big they ended up beating by. Would be my expectation. Plus, the home market looks pretty good for them right now. SoFi is also showing similar signs there as well. InnoData is down nearly 7%. Any news on that one just yet? Anything?
Nothing.
The
Coreweave backlog did increase $11 billion quarter over quarter. That's not bad.
Let's bring up their presentation.
Yeah, and it's crazy because they didn't announce any major deals. I think this past quarter, I think it's just a good amount of enterprise coming in this time. Unless I forget, did they announce something? Supposedly, there's rumors that there was an expansion to the Meta deal they already had, but that hasn't been confirmed yet.
That's probably true, though. Like that wouldn't even surprise me. Just the amount that they've been making partnerships with everyone. They're spending a crap ton. And I think they had a $14 billion deal before, right, with Meta?
Yeah, 14. I heard it went to like 19, closer to like 19, 20 billion.
Okay.
Is based on the rumors and reports I've read.
So does any of this stand out to you in terms of the numbers that we're seeing here? 11 data centers added in 2025, 3.1 gigawatts of contracted power.
The only thing is the contracted power increased a little bit. I think it was like 2.9 before. So it seems like they made some long-term contracts where now they'll have an extra 200 megawatts somewhere else. But to me, I think active power is always the most important. I think because that was the one that truly has that revenue driver right now.
And is this higher than expected, 850 megawatts?
No, that was what was guided after the delay of their data center. I think it was closer. It was expected to be like 990 before they announced the delay. And last quarter, when the delay, they mentioned it was going to be around 850, 860 by the end of the quarter.
Got you. This is always a question I've had because, like, whenever I look at stuff like the semi-analysis Platinum Cluster Max ranking, they stand alone at the top of those rankings. How much do you think that goes into whenever hyperscalers or other businesses are actually selecting them? Because we all know that, like, a NVL 72, like GB200, is not the same across every data center. Like the way it's set up, the way that they work with these chips depends on the actual output. And CoreWeave is standing alone in terms of their performance and pricing. Why, like, shouldn't this be shown in the numbers more than it is, or am I looking at it wrong?
I mean, I think it gets shown by the type of contracts that they have and the backlog they have. But at the same time, it's like your revenue can only grow based on your data center. And if you're at full capacity, you can't go
Right.
any longer. There. One of the things, though, it's very. I know a lot of people compare Nebius and CoreWeave and all these players the same, but they're always also trying to hit different markets, and the way they run these cloud computings are different. For example, Nebius, you could do things like virtual machines and a lot of other stuff that CoreWeave says, you know what, to make sure we have the best throughput on these AI tokens, we don't need those stuff on top. Our customers don't want that, so there's no point of putting that in our software stack solution. That's different customers but right now nothing is screaming out to me. Maybe they might share CapEx here. I actually haven't seen the slides yet, so they might be sharing CapEx here.
This is not is this updated here? Because that seems extremely small. That's what they have that they did do in 2025.
Yeah, it's 2025. Yeah,
and the majority just comes from Q4.
Really,
Q4 was over 8 billion.
Got you. Yeah, revenue backlog is exploding for them. I think I might have got the discount that I want to enter into this name, depending on how the call goes. But every time I've listened to their earnings or fireside chats, I'm always convinced. I mean, they're great.
I would say the only thing, their CEO stutters a lot, so it might seem like he's either I don't know. He's just extremely nervous, I feel. Yeah, and this 8.2 billion here of CapEx, it would have been a lot. I think it was going to be closer to 12 billion if it wasn't for the delay of the data center that they had. So it's going to be now pushed forward. So I believe we're going to get closer to a 30 billion, 35, maybe even 40 billion in CapEx. Now, I guess the question investors are going to have is like, where's it going to get that money? But
NVIDIA.
Exactly.
Yeah, they did some recent $9 billion loan thing with the banks recently. What was that about? You guys know what I'm talking about?
There was a report on I forget where it was, like back with Meta, I think it was. Is that what you're talking about, Tanner?
Something regarding the banks, that they were going to the banks for some sort of $9 billion loan or something.
Yeah, I think so. There was I think the report that came out like 5 days ago was CoreWeave was with the bank using their deal with Meta to just get financing at a better rate. So Understood. They go, look, we got this deal with Meta, and that's where the rumors also came out that the deal got bigger because they need more debt than they thought they did.
They use Meta as a
$8.5
cosigner.
billion.
They use Meta as a cosigner. Is that sort of what happened? They like, hey, you know what? Get us a better rate. Look at our big brother here that makes a lot of money.
Yeah, that or sometimes they're starting to use Jensen too as another cosigner.
Yeah. Okay. Quickly going back to the markets, because there is some pretty incredible movements after hours in today's pricing here. So what we have, Dell is now up 10%, which is a huge move for Dell. This is an $80 billion company up 10%.
Curious if Supermicro is reacting to that news.
Sorry, you say interested if they are?
Yeah.
SMCI is up 0.6%.
Not really. So I wonder if Dell is just getting better margins, because I know we continue to see the margin compression happening on Supermicro. I wonder if Dell is painting a different story where we don't have to fight too much in margins. I wonder if that's what's driving the stock up.
Clover Health up 5%, Flutter down 5.8%. Sunrun ended up spiking up. This was up like 16%, now a negative 1%. Rocket Companies up 8.7%, Autodesk up 8%, Innodata down 6.3%, Monster Energy, or beverages, I should say, down 3.5%. Marathon Holdings is up 13.2% right now. Zscaler down 5.6%. Block is now up 25%. All you needed to do was fire 4,000 people.
Going to be the year of fintech, it seems.
I mean, that would do well for me, but it's all the names that Well, I mean, Chime did well, but SoFi, Hood, these names are not doing well. Nubank ended up taking a shot today after amazing numbers.
Yeah, same as Mercado Libre.
Yeah, you hold that one as well, right, Neil? You hold Nubank?
I own Meli. No, I used to own Nu, but I consolidated into one Latin American giant.
No, man, you need to own both. They go together.
I mean,
like
I wouldn't
PB&J.
mind. I wouldn't mind, because both of them are incredible companies. Both of them got hit because they think about the long term and not the short term.
Yeah,
the market is stupid.
Yeah. I also hold D Local as well, but they don't report earnings just yet. Duolingo now down 23%. We might actually break today's lows, which is currently at $89.77. Currently, it's at $90.
Okay, so you want to hear why it's down that much despite having preliminary numbers?
Yes.
So we go from 33% bookings growth in fiscal year 25 to now maybe 10 to 12. Revenue from 39% growth to now 15 to 18%. Adjusted EBITDA margin 29.5% to now 25%. And gross margins 72.2% to 69%. That's all fiscal year 2026 guidance. They are expecting around $50 million in lost bookings. They are deliberately removing ads and subscription upsells that slow user growth, costing about 5 points of booking growth. So they are starting the year literally by saying, we do not want to monetize aggressively anymore. We want to try and grow our user base. And then once the user base is big enough, we'll monetize them again. The market clearly does not like that strategy at all, because what if it doesn't work out? Then you've suddenly slowed down monetization for nothing, because clearly it is working. The numbers for 2025 were very, very good. And now they're deliberately trying to slow that down in order to maybe grow users in 2026, which, I mean, their target is 100 million daily active users by 2028, which is almost double what they are at right now. Chess is doing very well, over 7 million daily active users in under 1 year. So maybe it works out, maybe not, but you can understand why the market did not like this at all, despite it being cheaper than before. It does change the profile of the company when you are going to have a year where literally you're going to be less profitable than the year before.
Hey, I mean, like, it's not a name I'm in, and I think that they can survive. I think what people are just honestly worried about too is, like, if any time that a new translation announcement or something like this is going to drag the sentiment down, who's to say that this is going to even stop for the next couple of years? There's going to be constant advancements, and I'm just like, I'd be scared to be in Duolingo as well, as much as their earnings still might be able to hold up, decent numbers.
But Xander, don't you think that's also just like a whole software problem too, as well? Like
I completely agree.
right?
Yeah, they're all down 80%.
Yeah, it's like whenever Anthropic or some of these guys drop a new model, and it's gonna happen until it doesn't happen. I think obviously eventually there's gonna be a point where the market wakes up and it's like, maybe we were crazy to think that. I still can't figure out what would be that turning point. Like, where would the market say, not even just for Duolingo, but for the whole software space? Maybe we've been overreacting with this whole AI story. There has to be something that like clicks it to shift. Just like with NVIDIA, it's like NVIDIA, you just keep wondering, oh, is this the top of CapEx? It's like, what is going to tell you that maybe we're going to keep going higher and higher?
Yeah. I mean, Tanner, did you see Robinhood today? We were green while Bitcoin was red. This is a completely
it doesn't happen
new
often,
thing. No, completely new thing. Also, we have some breaking news around the Netflix Warner Brothers story. So apparently, Warner Brothers said its board determined Paramount's revised bid as a superior proposal under its existing Netflix merger deal. Terms are $31 per share cash plus a ticking fee after September 30, 2026, with a $7 billion regulatory break fee. And Paramount would cover the $2.8 billion fee to exit Netflix. Netflix now has 4 days to revise its offer. As a new Netflix shareholder, I would now say thank you very much, merci beaucoup, but no thanks to Warner Brothers. Take the $2.8 billion and buy back $2.8 billion worth of shares.
Stock ran up to $87, now back to 85. Okay.
Yeah. The story is over in 4 business days, basically.
Well, how much content do you get with this if they get this, if they decide to go Game of Thrones, Sopranos, what like what are some of the big hits? Harry Potter, yes.
I mean the whole Warner Brothers HBO,
all Bugs Bunnies, right? All the Bugs Bunny stuff too.
Everything.
How do you think they're going to do it? Like, do you think they're just going to have like a Netflix sort of plan, or do you think that the plan was to do like a Netflix and the Netflix premium? Like a even higher
they
paid
still
tier.
plan on doing both, like Netflix and HBO.
Okay.
The HBO brand will still exist. The Warner Brother brands, of course, will still exist because it's an iconic brand. I assume Paramount is going to go the same way, but I mean, good luck to Paramount if they do pull this off, because they don't have the money. They don't have the money. I don't know how big the hole is going to be, but Netflix. For me, this deal was a good one for Netflix, but if the price is too high, the stock is down 35%. I'd rather them just continue what they've been doing, because that's been working very, very well. And now you can buy back, because the buyback program has been frozen now because of the acquisition, obviously. I mean, get back to buying back shares, and I think investors will be happy.
It's so funny now that I honestly think stock prices set. Well, I mean, we already know this. It's not like I'm coming up with some grandiose thing that I'm saying here, but like the stock prices are setting people's sentiment. Like people are looking at a completely flat and inline quarter from Block, and they're like, amazing quarter. I'm seeing all these posts online. I'm like, you're selling off companies that just did triple beats, down 5%, but the only thing that mattered was just say it. The quarter was crap. Cash App was worse than expected on revenue. Square was worse than expected on revenue. They are cutting their business and saying they're going to go full into artificial intelligence.
Wow.
Which I think that a company that is missing, that's exactly what you do. Like, you have nothing to lose.
Yeah, I mean, I know we joke about this, but if PayPal does the exact same thing with the new CEO, like they cut a decent amount, because let's face it, they don't need that many employees. Venmo is performing better than Cash App. I don't see how PayPal does not see the same reaction. Of course, it's hopium on my part because I still own my options, but it's like you said, it's not like this was a great quarter for Block. Without the 40% cut, this thing would have been down another 10-15% or so. But hey, if they can do the same thing with 40% less, then I guess it becomes good enough.
We need to get more information on Dell as well. This is now up 13%. They're a huge name in the data center space as well.
I'll start looking to the presentation real quick, and I'll see if anything I find.
Yeah, clear double beat. Outlook for Q1, $35 billion. Well, actually, $35.3 billion of revenue. Full year expected to have $140 billion in revenue. That's incredible. Okay. Zscaler, where is that one? Down 8%. Looks like a double beat. ARR is up 25% year over year. Guidance was this is a clear beat. I don't know what it's down for.
It's down every quarter after a double beat for Zscaler. I don't know.
Guidance was higher than expected. This is a triple beat.
Are they still unprofitable? Probably, maybe a little bit.
Maybe it's adjusted EPS of $1.01. So I don't know what the GAAP number is. That could be it, but
yeah. Or in all, it's another good quarter by them. So I maybe they're not growing fast enough. I don't know.
Marathon Digital pushing new highs today, right now, about to break $10 a share. It's about to break $10. They're up 18%, just broke the $10 mark. And oh, this must have been some commentary. There must be something big in here because it looks like a double miss from what I see. They signed some large customer or something for like data centers or something.
Who is this? Mara Holdings. Okay, another
Yeah.
PowerShell player.
Yeah.
Nice. I don't know if Tanner, I know you were talking about Dell for a moment, but I might be repeating stuff here. They did increase their dividend 20%. They increased their buyback, a $10 billion increase in share repurchase program. Guidance for the full year, 23% on revenue for a full year for 2020 for the upcoming year, and earnings per share growth of 33. They also mentioned they closed with more than $64 billion in AI optimized server orders. So they have a backlog of around $43 billion right now for the upcoming year just on AI servers. So a lot of demand there, and it seems like they are coming back and paying investors as well, shareholder returns.
I mean, $140 billion in revenue versus the $125 billion expected for the year is not too bad.
Yeah.
Not too bad.
I'm just looking through Marathon's.
With Dell, I would also be curious. I mean, obviously, right now the story is AI servers, but we've heard from NVIDIA yesterday. I mean, we keep hearing that the consumer tech is definitely going to see a bit of pain due to the memory space, and Dell obviously has a lot of consumer-based products. So I wonder if that's going to create any forms of headwinds. But at the same time, I'm pretty sure they can just sell high-end AI laptops to all these AI companies and make up some margins there.
Really quick news on Kratos here. Kratos announced a $1 billion common stock offering with underwriters giving a 30-day option to buy an additional $150 million of shares. So potentially a max of $1.15 billion raise. Kratos said that the proceeds will go towards acquisitions, CapEx, and investments for national security programs and general corporate purposes. Stock is now down 6.66%. That's not... Someone's got to buy a share. We can't keep it at that price. Okay. Yeah, I mean, the big winner of the day, surprisingly, it is always the names that would surprise you the most. Block up 22.4%. Dell up an additional 12%. Marathon Digital up 15, nearly 16%. And the biggest losers, Flutter down 7%. That's up 10. Wow.
Autodesk is up 10. Oh, wow. Nice.
Yeah, Autodesk up 10. Duolingo down 22. I think they took the cake. Yeah, so Block and Duolingo. That's the range. Somewhere in between is Coreweave and Copang. I didn't actually see numbers for Copang. I don't even know if they're supposed to drop just yet. Well, I mean, I assume they did, but they're down 3%. That's a South Korean e-commerce play.
Indeed, with American roots. Did
Yeah,
you know
you hold
this?
this name as well. You hold 1,000 names.
No, I don't own this name. I cover this name, but I don't own.
That's what I should
name.
say. You cover 1,000 names.
Yeah. No, I mean, I only discovered the American roots thing recently when there was this political spat between South Korea. Because I was 100% sure this was 100% South Korean company, but apparently not. Apparently not.
Yeah.
What price is Coreweave at right now, Tanner?
Coreweave's down 5.1%, $92.75.
Not bad. That's a light day for Coreweave investors.
Yeah.
It's almost like we didn't have earnings.
This is
guidance.
This is a typical day for Coreweave.
Do you guys know how to get the listen to the call and get the price at the same time? I don't know what that app that Amit sometimes uses.
I do not.
Doesn't whenever he just share the full screen and he just overlays two things one on top of the other?
No, because if you share the full screen, then you don't get the audio.
Mm.
It won't showcase audio. I thought it was Benzinga, but I don't know how to pull it up. If you guys can find that, let me know. If not, I'll just keep writing the price into the chat and throwing it up on screen. And I can just, do something like this.
Yeah, I don't know. He's holding on to that secret. I just never asked him, so I don't know.
Freaking StreamYard, it sucks. Whenever I stream solo, I use a different thing that will allow me to put up multiple assets on screen. So I can do it very easily, but
what do you use? Streamlabs?
Streamlabs if I'm solo streaming, yeah. Yeah. And I've just made my dashboard look the exact same as StreamYard. Same background, same position in the cameras. Stuff like that. Okay, Earnings Hub could do it, but sometimes their calls lag out. I'll try, and I think the price only updates on the minute to minute, so it'll be a little bit slower, but at least it's something.
Yeah, it's something.
I'll do that.
Yeah.
Call is in 20 minutes.
Yeah, I think with Coreweave, a few things that investors are going to want to listen to. First is just they didn't give us guidance on like what active power they expect for Q1 at the end of Q1.
Is this something that they usually do?
Yeah, they tell you about like how much active power they expect within the next quarter, or the time frame, or maybe by the end of the year. So how much data centers are they planning on build up for next quarter? Because they have so many being built up at one time. So they try to give you that active power, and revenue guidance as well is what we would be expecting. Any discussions on the delays? The delays, as we saw, it didn't come online in Q4, but should it come online in Q1? That one data center, CapEx, and I think there's going to be plenty of questions around debt. So I think those are going to be some of the few points investors need to really keep an eye out. For me, active power and CapEx are going to be the two biggest ones.
Active power and debt, is that what you said?
Yeah,
CapEx.
Yeah. CapEx.
CapEx. Okay. Yeah. Holy. Yeah, I just saw a comment on X that just said, sometimes all you need to say is, we like AI. Block is now up 25%. Yeah. And taking the jobs away of 4,000 people. One of the two things. A mix of both ends up getting you into the double digits.
Did we end up seeing who Mara Holdings had the contract with, or?
I did not. I'm actually surprised. I tried. I didn't actually bring up their slide deck. There wasn't a lot of people posting about it. I thought this name was extremely popular. but I didn't see too much on an earnings post.
Rocket Lab's only down 3%. I mean, with Rocket Lab, the only thing that matters is Neutron right now. So as long as that's on track, although that's been delayed, so
Marathon announces a strategic partnership with Starwood Digital Ventures to accelerate delivery of cutting-edge hyperscale enterprise and AI capability digital infrastructure. The joint partnership is expected to deliver an approximate 1 gigawatts of near-term IT capacity with pathways to more than 2.5 gigawatts.
I wish they would to tell us, like, what does in initial development phase, like, how long would that take?
Yeah. I'm not seeing too much about it just yet.
Quick Rocket Lab info.
Yeah.
So apparently, Neutron first launch is now targeted for Q4 2026. So pushed back even more.
What was the original time frame on that?
Original was, I think, now. And then first half of 26, I believe, and now Q4. Which, I mean, to me, I guess I'd rather them push it back a little bit and not just rush, do it, and then the whole thing explodes, and that costs a ton of money, and they didn't learn anything from it. But if the stock goes down, then that's fine by me.
Oh my gosh, man. If tomorrow block actually settles at like today was up 5%. Now it's back to $67 a share. That's a, I mean, we still have a long way to go, but if that actually holds tomorrow morning, that'll be quite surprising.
I mean, Jack Dorsey is yet to speak, so the guy doesn't know how
to fuck it up. No, he's working hard, but
on his beard.
Yeah, it's much easier to vibe code than actually code on a yoga mat. He likes to mix business and yoga sessions.
Yeah, I mean, he does like green, so I guess seeing his stock up 20% is nice for him.
I remember their initial goal of getting back to the rule of 40. I wonder where they are now.
Oh, I see here with Simon here on my chat. I was even reading. It seems like Mara acquired 64% stake in a company called Exion for sovereign enterprise AI capabilities. So that they had that joint venture with Starwood Digital Ventures to pivot from pure play Bitcoin mining towards energy for data centers, and then they also made the acquisition of that other player to focus also in sovereign enterprise AI capabilities.
Why is SoFi selling? What did SoFi do?
Does SoFi need a reason to be down?
Yeah, I guess not.
Are we still eligible for a supposed S&P inclusion, or just...
My understanding is yes. Although, well, actually, the price is back above 24, but I think the actual set date was 5 weeks before their announcement, and on that particular day, we were above 22.7 billion. But it's not even that I'm calling to get in Q1. I just think that I think there's a high chance that we get in 2026 in general.
Yeah, no, that's also my call, 26 in general. My question to you is, what's stopping you from selling other things and just putting it into SoFi at $90 a share?
Buying NVIDIA.
Yeah, because Coreweave is down to, honestly, I'm actually thinking the other way around. I'm like, how am I not betting everything on these companies that are growing at triple digits in the biggest AI phase or AI build out, and especially in the cloud names or in neo clouds? Like, this is recurring revenue. There's no build out phase. CoreWeave and Nebius, these are going to be like utility companies. Like everyone pays their AWS bill. There's not like there's no spikes in their revenue and then comes back down. Like this is just where people build their businesses. So
yeah, but SoFi is profitable and is expected to grow by what is it, close to 40%?
I agree, but profitability, schmofitability, okay?
That who cares about that?
Yeah.
AI.
We have AI and tokens now. That's what the world's about. No, but I haven't sold a single share, and in fact, I purchased just recently a large stake in SoFi at 18. But going all in, I like my portfolio. I like what I hold.
Not going all in, just putting even more weight on it, because I mean, $19 is tempting, and at least you don't have the AI scare, but I guess SoFi does participate in this AI sell-off because we are now on
SoFi
$20.
Banking gave a loan to CoreWeave. Oh, there's the scare.
Yeah. A personal loan.
I highly doubt the CoreWeave would pass for a
the underwriting
loan.
That's really funny. Yeah, we only give the money to hyperscalers. No, but seeing names like rocket companies up this much is a pretty bullish sign to SoFi as well.
You know, it was cool to hear Jensen talk a little bit about the space market yesterday. I'm not too excited about space data sensors, but it was cool to hear his thought process. And pretty much what he said is like, he sees the reason for it to happen, but he's still more excited about land data sensors for a while.
This is a mortgage company, though. But yes, the space industry is exciting.
Oh, I thought we were talking. I thought the other one was here. The one with Neutron. I forget what the.
Yeah. Rocket Labs. This is Rocket Companies. They're a mortgage business. But yeah, that's. I just like that being like, yeah, Rocket Companies is doing really well, and you're like, yeah, Jensen also likes data centers in space. Okay, we have 12 minutes. Also, it's just a poor name for a business in this type of environment. How many people bought Rocket expecting that, they thought they were buying a thematic play, like, oh, everyone's betting on Rocket companies.
Sometimes I make the mistakes of Rocket Lab being the mortgage company because I need a mortgage company first.
Oh, really?
Yeah.
I do wonder if Rocket stock moves every time Rocket Lab has a big announcement or something.
Sometimes that does happen. Like C3 AI was benefiting a lot from that. Like anytime like AI was moving, the ticker is just people are like, okay, I'll go buy AI.
That's what I said under a Dan Ives tweet 3 years ago when he put a $50 price target on his LeBron of AI and said the best thing this company did was purchase that ticker. And since then,
he called C3 AI the LeBron of AI.
Yes, sir.
Yeah.
Sometimes he hits with the Messi of AI, but sometimes he does miss with a C3 AI and even a Rivian. I think he had a Rivian price target of $130 or something.
Yeah, the C3 AI has never given me a good feeling.
No, when you change the name of your company every time there is a new team going on, it's a red flag.
But do you think that red flag also persists with, like, if it wasn't for the performance that Coreweave actually put up, I mean, like, their origins did scare me. I don't like that they pivoted the business to take advantage of what's hot. However, it does seem like they're actually the best out of all these businesses.
That's the difference. If you get co-signed by Jensen, it's a whole, it changes. It's like, he's a smart man. He knows something.
Yeah, if it didn't work out, I would say yes, correct, red flag, let's move on. But clearly they're doing something well. I mean, over $60 billion in backlog, investment from NVIDIA, huge client list. I mean, they're not giving money away for free, although some people might say, yes, they are. I don't think they are.
Well, what do you think about the contract terms between names like Nebius or Coreweave or IREN? I know that people have had some commentary to say that IREN's deal with Microsoft was maybe less favorable towards IREN than what they did with Coreweave. Is there anything that you point to say, hey, you know what, Coreweave is actually being taken seriously? Or Any commentary on that in terms of the actual contracts that they're signing?
I've even heard other companies. I forget what kind of. I don't know if it was someone mentioned it. One of the other mining companies also even said the same thing. They didn't name Iran, but everybody knew they were talking about that one where it wasn't favorable. I don't even know where I was going to go with this. I was going to say, I think with Nebius and CoreWeave, one of the things to see is I see differently. I feel like Nebius is trying to become the AI cloud, or kind of like that AWS where you have things like virtual machines and all these other solutions that you can kind of get in AWS. I think CoreWeave is trying to become that thing that Jensen talks a lot about, AI factories, which is a completely different situation of kind of the data center. So CoreWeave, I see more of like the AI factories that Jensen talks about, which is pretty much just a token factory. I see Nebius more as a AI cloud motive, where you kind of get the enterprise space. You have the virtual machines. You have a lot of these other cloud stack solutions on it. So I think that's why they're two unique players, and they both have their strengths.
I don't follow CoreWeave nearly as closely, but they did something with some AI storage solution recently in the last 6 months. Can you speak to that and how that's more a sort of a solution for a more broad-based cloud, like that's more of a general cloud solution, and how they're trying to offer like a one-stop shop almost? Is that the way to think about it?
Yeah, I mean, for them, it's just to optimize just token output. I know with the storage solution, I mean, they're NVIDIA's yes man at the moment. I know with the storage solutions, they're even adding more of like, we see NVIDIA doing this new Bluefield storage solution that's being added. They're going to be one of the first to do it. So they mentioned the annual run rate of that is already in the north of $100 million for some of the storage space. So all this is just kind of, again, to continue to grow the token output. And that's where like CoreWeave shines. It's like, if you purely want that AI token factory, where it's like all you care about is token ins, token out. At the moment, that's where CoreWeave is truly trying to play its strength.
And Nebius.
Also,
Nebius
I was
is
just
so
taking a
good.
look at Microsoft stock there. Few minutes till we end up getting into the call, but they're down 1.3% in the after hours here. I tried looking for any piece of news on online. I couldn't see anything.
Microsoft has really been struggling it's back to April prices.
That's quite a large correction just for an after hours move, and you're not reporting.
Yeah. But what happened?
Ooh, you know what? This actually might. Oh, never mind. I see a comment about JD Vance telling them to. Oh no, I don't know. I'm not sure. But we did end up seeing sort of almost like a second round of selling on CoreWeave, initially taking us down, and then even further here. Maybe we're seeing this across the markets. Let me go ahead and see.
Down 8%.
The SPY is down 0.2% in the after hours, and the QQQ's roughly the same.
What is Amazon and Google doing right now? Are they also down about 1%?
No.
Amazon 0.2.
Right. No, so there definitely has to be something going on here with Microsoft.
Oracle 1.1, but then again, it's Oracle.
But
so
I think Microsoft, Oracle is more of a proxy with
CoreWeave.
With CoreWeave. Yeah, I wouldn't put Microsoft here. I'm here on X. I don't know if you guys see anything.
I don't see a thing. Not on Microsoft.
People are saying software stocks are down after hours, though. There was IGV is down 1.5. ServiceNow is down 3%.
Yeah.
That could be it.
Salesforce.
Yeah, because I think Microsoft's one of the larger names in IGV, no?
Yeah.
It could just be a broad sell-off across software right now.
Microsoft gets punished for everything. AI cloud, punished. Software, punished. OpenAI, punished.
Yeah. I mean, in IGV, number 2 is Palantir, number 1 is Microsoft.
Is Palantir also down?
Yeah, they should be down 1% then to make my case legit.
Nope,
No, they're up.
Nope. And it's up.
So what happened here? What is this?
Oh man.
I don't know.
That looks almost like a press release. UBS upgraded Palantir to a buy from neutral with a $180 price target. Yeah, that was a press release.
Okay, so Palantir got saved by a press release from the software names here.
Yeah.
Enough to offset
$180
that.
price target.
But why are SaaS down now after hours? Did like a new model get released?
Claude released Anthropic with a new marketing video.
Yeah, I'm not sure. Do you think it's related to the sort of block, like just another large layoff? Like, because although the actual amount of customer or like users, like a 4,000 person layoff is not crazy, but whenever you only have 10,000 people working at your business, that is pretty insane. That's like what Klarna said they were going to do, but then didn't. Like, maybe it's just a general sell-off on, hey, AI is absolutely legit, and companies are starting to make real sell-offs. Like that could hurt seat pricing. That could hurt. Honestly, I'm convinced that's what it is. I've convinced myself.
What did you convince yourself of?
That block is causing this.
Yeah, more layoffs is block. More layoffs is causing people to punish seat-based pricing software names.
Or is it Duolingo's job showcasing that the software story is dead because of AI?
Yeah. No one's learning English to come over to America, so you have to sell off Microsoft.
Somebody says there might be Iran news happening right now, so some global. No, but then we would have also seen it.
I'm telling you, Workday's down 5.4% right now in the after. A seat-based price, like Salesforce is down 4%. This is what it is. I'm shouting from the rooftops.
But I think it might be. Just kidding.
I mean, how many software licenses did Block really have? Let's be honest.
No, but it's the theme. It's the theme, Neil.
The bear
just gotta
case,
add the word theme to it.
The bear case for all these software players would have been if Block used them and they still sucked.
For real, sometimes I feel like Chicken Little. I'm like, the sky is falling. You guys aren't listening to me. Okay, call is coming up here in the next minute. I'm going to try to get it on Earnings Hub, but I'm not even really sure I know how to get to the price and the call at the same time.
I mean, Krispy Kreme stock was up almost 30% today.
You know what? I'm just going to bring up the webcast. That way we have crispy, clean audio. At the end of the day, that's what's going to matter. Well, I don't know. Dude. Okay, here, I'll show you.
Wait, I didn't know you made a joke because Neil's talked about Krispy Kreme and then you said crispy audio, so I thought it was like a joke, but I guess it was just coincidence. Hey, don't demonetize us now.
I'd pause it. Okay, but how do I get the price? So if I just play it from here, or can I make it full screen? Okay, whatever. Well, how about that?
That sounds perfect. Well, looks perfect.
And I think it updates every minute.
This episode was sponsored by no one.
That's what I was also thinking. I'm like, this is ridiculous. Okay.
And these earnings calls should really use copyright-free music.
Agree. Why could they do it and we can't? That's wild.
Is that them?
Yeah.
Hello, and thank you for standing by. My name is Tiffany, and I will be your conference operator today. At this time, I would like to welcome everyone to the Coreweave fourth quarter and fiscal year 2025 earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during that time, simply press star, then the number 1 on your telephone keypad. I would now like to turn the call over to during that time. Simply press star, then the number 1 on your telephone keypad. I would now like to turn the call over to Coreweave. Please go ahead.
Where it's playing from.
Thank you. Good afternoon and welcome to Coreweave's fourth quarter and fiscal year 2025 earnings conference call. Joining the call today to discuss our results are Mike Intrator, CEO, and Nitin Agrawal, CFO. Before we get started, I would like to take this opportunity to remind you that our remarks today will include forward-looking statements. Actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are set forth in today's earnings press release and in our annual report on Form 10-K to be filed with the SEC. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investors.coreweave.com. A replay of this call will also be available on our investor relations website. And now I'd like to turn the call over to Mike.
Good afternoon, everyone, and thank you for joining us. 2025 was a defining year for Coreweave. We generated more than $5.1 billion of revenue, up 168% year over year. Grew our contracted revenue backlog to $66.8 billion, an increase of $11.2 billion sequentially, and more than $50 billion year over year. Reached more than 850 megawatts of active power as of December 31st, and added approximately twice as many new reserved instance customers in Q4 versus any quarter in our history. We delivered these results while quickly resolving the data center delays we discussed last quarter, delivering the impacted deployments ahead of our Q3 earnings call expectations. Coreweave is the fastest cloud in history to reach $5 billion in annual revenue. We remain in the early stages of the most transformative infrastructure build-out in history, and Coreweave is at the forefront, building and operating some of the largest purpose-built AI clusters for the world's most demanding workloads. Strip away the complexity, and 4 fundamentals define where we stand. 1, a demand environment that remains relentless, driving rapid adoption from an increasingly diversified set of hyperscalers, AI native, and enterprise customers. 2, expanding opportunities for new margin-accretive avenues to monetize Coreweave Cloud, unlocked by the evolution of our platform beyond GPUs and the recent expansion of a partnership with NVIDIA. 3, a rapidly growing data center footprint underpinned by unmatched execution and a strategic approach to capacity expansion. And 4, a disciplined financial model deliberately designed to invest ahead of revenue to fulfill contracted demand, backed by $66.8 billion in revenue backlog and providing strong visibility into durable cash flows, attractive returns, and the ability to drive down our cost of capital. We will speak to each of those today. Regarding demand, the signals we are seeing across hyperscalers, AI natives, and enterprise customers are only intensifying as AI workloads get more complex, models scale faster, and adoption continues to proliferate. The breadth of this demand has translated to deepening engineering relationships with our largest customers and material progress on diversification. Coreweave is supporting the next generation of AI pioneers. As I mentioned in Q4, we added approximately twice as many new reserved instance customers as any prior quarter in our history. including AI native and enterprise companies like Cognition, Cursor, Mercado Libre, Midjourney, and Runway. We also expanded our relationships with some of our largest partners, including both of our existing hyperscale cloud customers. Demand accelerated from each of these customer types, while pricing remained stable throughout 2025. Trends that we have seen continue as we have started 2026. In total for the year, we grew the number of customers committed to spending at least $1 million on CoreWeave Cloud by nearly 150%. These are not one-time infrastructure deployments. They represent sophisticated, multi-product opportunities, the early chapters of enduring platform relationships, and a growth engine that compounds as AI becomes more deeply embedded in how these companies operate. We are also seeing significant increase in demand for prior generations of GPU architectures, where supply also remains constrained. Average H100 pricing in Q4 was within 10% of where it started the year, while average A100 pricing increased in 2025. From our customers, we understand the demand for this infrastructure is largely for inference use cases, which are proliferating rapidly. We are signing this infrastructure into new reserved instance contracts ahead of when it becomes available, firmly putting to bed concerns about demand for older generation SKUs. With largely all of our new 2026 capacity allocated, we continue to work diligently to expand our footprint to meet the overwhelming needs of existing and prospective customers for both near and long term. These trends reinforce our conviction in the durability of demand and the longevity of this technology while running on CoreWeave Cloud. In light of the insatiable demand environment and the persistent signals we are seeing from customers, we are accelerating our roadmap with the objective of adding more than 5 gigawatts of additional data center capacity beyond our already contracted footprint by 2030. Moving on to new avenues to monetize CoreWeave Cloud. Our platform is evolving as we unlock margin-accretive avenues for growth through new products and services, as well as offering our proprietary cloud stack outside of our data centers to the broader NVIDIA ecosystem. AI natives and enterprise customers are not just consuming our core GPU infrastructure. They're engaging with our unified platform at significantly higher rates across CPU, storage, software, and development tools. The opportunity to add additional value to these customers as their AI workloads mature is substantial and represents meaningful upside over time. This is already showing up across our platform. For example, approximately 80% of CoreWeave Cloud customers paying at least $1 million per year have adopted one or more of our storage products. Additionally, we are seeing strong cross-selling momentum with weights and biases as we added hundreds of millions of CoreWeave Cloud TCV from weights and biases customers in the second half of the year. We have also accelerated the development of CoreWeave's proprietary cloud stack, reference architecture, and related software solutions, including Sunk and Mission Control, which orchestrate every layer of our purpose-built cloud and increasingly define the CoreWeave customer experience. In January, we announced NVIDIA intends to test and validate our platform, including our software and reference architectures, to work towards including those offerings within NVIDIA's reference architecture for cloud, enterprise, and sovereign customers. Already, we are seeing select customers license Sunk as their default research cluster management platform across their multi-cloud footprint. We expect the broader distribution of our proprietary cloud stack to become a growing source of higher margin revenue over time. The ability to monetize our platform, both inside and now beyond our own data centers through third-party licensing agreements, substantially expands our addressable market. This represents tangible long-term upside potential that is not reflected in the 2026 guidance as we are providing it today. On to execution. We ended the year with more than 850 megawatts of active power, adding approximately 260 megawatts in the fourth quarter alone across 43 active data centers, up from 32 at the start of the year. We contracted close to 2 gigawatts of additional power in 2025, ending the year with more than 3.1 gigawatts of contracted capacity, virtually all of which we expect to come online by the end of 2027. Our contracted but not yet active capacity represents latent revenue potential that we will monetize as built and delivered. We will continue to strategically source land, power, and data center shell infrastructure. Particularly looking beyond 2026, we see robust opportunities in the current market for CoreWeave to grow our contracted power capacity, and will also selectively leverage our expanded collaboration with NVIDIA to accelerate our roadmap further to better meet demand. Operating at this scale and pace is inherently complex. When disruptions surface, we move decisively through disciplined coordination across teams and partners. We quickly cleared the delays discussed in our third quarter earnings call, and in total, we have now delivered more than 50,000 Grace Blackwells to the impacted customer, deploying servers on a rolling basis and delivering them within weeks of receiving access to the requisite data center infrastructure. We are delivering at this breakneck speed across several different sites, handing over tens of thousands of GPUs to different customers simultaneously. We believe CoreWeave is the only cloud platform that can move at this pace while providing the industry-leading performance and reliability that drives customers' trust and allows us to capture additional wallet share. The feedback and the results we are seeing from our closest customers is inspiring. Grace Blackwell running at scale on CoreWeave Cloud is revolutionary. In Q4, we became the first cloud platform to reach NVIDIA's exemplar cloud status for GB200, while remaining SemiAnalysis' sole platinum-ranked AI cloud. We expect to remain at the forefront of execution and innovation across the AI cloud stack as we become one of the first to bring NVIDIA's new Rubin GPU platform to market in the second half of 2026, while expanding our product portfolio to include NVIDIA's Vera CPU and Bluefield storage. The integration of these newer technologies into our proprietary cloud platform will help power new capabilities, including agentic workflows for our customers. The pace of our execution also explains why our capital expenditures for Q4 came in above guidance. Our teams were able to bring infrastructure into service ahead of our expectations, which we view as a high-quality acceleration of revenue capacity for 2026. To put our current scale into perspective, according to third-party estimates, CoreWeave today is larger than the 15 largest neoclouds across North America and Europe combined. Bringing more than 260 megawatts online in a single quarter requires simultaneously orchestrating hardware, networking, storage, and purpose-built software across more than 100,000 GPUs and millions of interconnected system components, all in near perfect unison. This is among the most operationally complex undertaking in the technology industry. It is also what CoreWeave does better than anyone. And finally, Turning to our financial and business model. In 2026, we expect our CapEx will be at least $30 billion, more than 2x the CapEx in 2025. I want to frame that number in clear terms. This is a reflection of the extraordinary amount of contracted demand in front of us. Our revenue backlog has grown to $66.8 billion, and the vast majority of our intended capital deployment is to directly support this long-dated contracted demand, where we have direct visibility into our long-term margins, underpinned by durable cash flow. The dividends of these investments will compound, as you will hear from Nitin, as he provides some commentary around our targets for 2027 and beyond, in addition to our 2026 guidance. This backlog will continue to be primarily financed with the asset-level delayed draw term loans that we introduced to this market. We expect to continue to reduce our weighted average cost of capital along the way, while unlocking broader industry participation in the facilities. There is a diverse and growing demand to participate in CoreWeave's capital market journey. We have cultivated a phenomenal financing vehicle for our business that enables us to scale at the pace of artificial intelligence, while staying on our targeted path to reach investment grade. Before I turn it over to Nitin, let me leave you with a few final thoughts. We have $66.8 billion of contracted revenue backlog, with every contract for new capacity expected to begin generating revenue by year-end 2026. We are delivering cloud infrastructure and converting it to revenue today. We are building and operating some of the largest purpose-built AI clusters for the world's most demanding workloads at a pace and quality second to none. The demand driving the build-out is relentless, diversified, and growing, with customers engaging across our broadening product suite. Our contracted backlog gives us, and you, clear visibility into the trajectory ahead. The expansion of our collaboration with NVIDIA positions CoreWeave's platform as the natural destination for cloud, enterprise, and sovereign customers seeking optimal AI infrastructure performance inside and now beyond our own data centers. Our ability to see into the future of AI innovation and build towards its requirements is unmatched. We will continue to invest and grow this incredible market advantage with discipline and contracted cash flows as we deploy capital strategically to expand capacity, deepen our product suite, and develop the AI cloud that our customers demand. Our priority remains clear: deliver the most performant, reliable, and efficient AI platform for our customers at global scale. The market is accelerating, and CoreWeave is primed to be both the beneficiary and the enabler of the AI revolution. With that, I'll turn it over to Nitin.
Thanks, Mike, and good afternoon, everyone. Throughout 2025, we executed with discipline against the strategy we laid out for the year, beginning with our IPO. We significantly diversified our customer base, more than doubled our contracted and active power capacity, and strengthened our balance sheet by unlocking new funding sources while lowering our weighted average cost of capital. We also broadened our product portfolio, both organically and inorganically, successfully completing 4 strategic acquisitions to pull forward our roadmap. The current pace of the market and scale of demand for CoreWeave Cloud has created a clear opportunity, and in 2026, we are investing deliberately to meet it, accelerating our plans to further extend our leadership position. Turning now to Q4 results. Revenue was $1.6 billion in Q4, up 110% year-over-year, driven by robust customer demand and exceptional execution. Full-year revenue was approximately $5.1 billion, up 168% year-over-year. Demand for CoreWeave Cloud continues to intensify, with revenue backlog for the quarter ended at $66.8 billion, up more than 4x this year alone. As Mike noted, we made significant progress diversifying our customer base across hyperscalers, AI natives, and enterprises, a stated goal at our IPO last year. Moreover, the customers are committing their foundational AI workloads to Coreweave for longer periods of time, resulting in the average weighted contract length increasing from roughly 4 years to roughly 5 years. We have $66.8 billion of revenue backlog, with every contract for our new capacity expected to begin generating revenue by year-end. We are delivering on our commitments today. These commitments are being made to current and past GPU generations as a part of broader customer roadmaps, with active conversations already underway for future SKUs. Operating expenses in the fourth quarter were $1.7 billion, including a stock-based compensation expense of $157 million. We were able to deploy our data center and server infrastructure faster than expected, while bringing online more capacity this quarter than any in our history. This drove the corresponding increase in our cost of revenue and technology and infrastructure spend. In addition, the increase in sales and marketing was driven by investments in scaling our go-to-market organization to capture the rapid growth of the AI opportunity. The increase in G&A was driven by professional services related to M&A and financing activities, public company costs, and additional headcount to support our growth. Adjusted EBITDA for Q4 was $898 million, compared to $486 million in Q4 of 2024, increasing nearly 2x year over year. Our adjusted EBITDA margin was 57%. Adjusted operating income for Q4 was $88 million, compared to $121 million in Q4 of 2024. Our Q4 adjusted operating margin was 6%. Adjusted operating income was lower than expected as a result of deploying infrastructure ahead of our expectations. Net loss for the fourth quarter was $452 million, compared to a $51 million net loss for Q4 of 2024. Interest expense for Q4 was $388 million, compared to $149 million in Q4 of 2024 due to increased debt to support the scaling of our infrastructure. Adjusted net loss for Q4 was $284 million, compared to $36 million in Q4 of 2024. Turning to capital expenditures, CapEx in Q4 totaled $8.2 billion and $14.9 billion for the full year, higher than anticipated due to our team's ability to put infrastructure in service ahead of our expectations. As we previewed last quarter, the meaningful growth in construction in progress in Q4 to $9.4 billion, an increase of $2.5 billion quarter over quarter, reflects the significant scale of infrastructure we are on track to deliver in the near term. As a reminder, construction in progress represents infrastructure not yet in service and not yet being depreciated. As these assets come into service, they will drive incremental revenue and corresponding depreciation. Our financing structure is designed to match this deployment model. The large majority of our term debt is structured as delayed draw facilities, meaning capital is only drawn as the data centers are operationalized. While global supply chains remain complex amid persistent supply-demand imbalances, we have consistently navigated these challenges through operational discipline and strategic sourcing. Our track record of bringing infrastructure online at scale gives us confidence in our ability to adapt and continue accelerating capacity deployments in 2026 and beyond. Now let's turn to our balance sheet and strong liquidity position. As of December 31st, we had $4.2 billion in cash, cash equivalents, restricted cash, and marketable securities. We continue to make significant progress in strengthening our capital structure and lowering our weighted average cost of capital. In Q4, we raised approximately $2.6 billion via our inaugural convertible senior notes offering, where investor demand dramatically exceeded the offering size, leading to its upsize. We also expanded our revolving credit facility in the quarter to $2.5 billion to manage liquidity and support our various growth initiatives. In total, in 2025, we secured more than $18 billion of debt and equity, working with more than 200 investment partners and financial institutions, reflecting the depth and diversity of capital committed to Coreweave's growth. As Mike discussed, in January, we announced the expansion of our commercial relationship with NVIDIA, which was accompanied by a $2 billion investment in Coreweave in support of our platform, team, and shared vision for the AI infrastructure at scale. Our efforts in Q4 and over the past year to optimize our financial structure and lower our weighted average cost of capital is evidenced by the 300 basis points decline in our weighted average interest rate during the year and represents a total reduction of nearly 600 basis points since 2023. To put that in perspective, the 300 basis points improvement represents nearly $700 million in annualized interest savings based on our Q4 debt balance. Going forward, we expect to continue to be able to reduce our weighted average cost of capital as capital providers and rating agencies increasingly appreciate our best-in-class execution, as well as the durability of and visibility into the cash flows that underpin our take-or-pay customer contracts. We have no debt maturities until 2029 other than self-amortizing contract-backed debt and OEM vendor financing. Turning to tax, we recorded a non-cash tax benefit in Q4, driven primarily by the impact of One Big Beautiful Bill Act. Our tax rate might fluctuate significantly in the future due to similar factors. Demand continues to intensify and diversify across all customer categories. We are accelerating investments deliberately to capture the contracted demand, and the long duration of those commitments give us clear cash flow visibility to deliver best-in-class cloud margins as the deployed capacity matures. We expect 2026 CapEx of $30 to $35 billion, which is more than double our 2025 investment. Substantially, all of it is tied to our already signed customer contracts that we intend to bring online this year, as we expect to double our active power capacity to more than 1.7 gigawatts by year-end. As I have described previously, when new capacity comes into service, data center lease costs, including power and depreciation expense, commence, while customer revenue ramps over subsequent months. In 2026, this effect is amplified by the scale of our deployment program. We will be bringing online roughly double the capacity of 2025, which means a corresponding increase in depreciation running ahead of associated revenue recognition. For full year 2026, we expect revenue of $12 to $13 billion, representing approximately 140% growth year over year at the midpoint. We expect adjusted operating income of $900 million to $1.1 billion. We anticipate margins will ramp sequentially from low single digits in Q1, expanding in each of Q2 and Q3, and returning to low double-digit levels by Q4 as deployed capacity matures and revenue scales against the existing cost base. Our 2026 margin progression is a result of deliberate investments we are making to meet the insatiable demand for our platform. As our business and growth normalize, we remain confident in our ability to achieve 25 to 30% margins over the long term. Our mature revenue contracts generate contribution margins in the mid-20s, which, combined with the ramp-up of margin-accretive products and services we continue to unlock, gives us conviction in our ability to achieve this target. Our 2026 guidance excludes any potential meaningful revenue or margin benefits from the further monetization of Coreweave's proprietary cloud stack to other NVIDIA cloud, enterprise, or sovereign customers, which we do expect to begin in 2026 and to become more meaningful in the coming years. This represents tangible long-term potential upside. For Q1 specifically, we expect revenue in the range of 1.9 to 2 billion. We expect Q1 adjusted operating income between 0 and 40 million. Q1 represents the trough in our annual margin trajectory as we expect our CapEx deployments to be 6 to 7 billion of infrastructure in the quarter, as we continue to bring online significant further capacity beyond the approximately 260 megawatts we added in Q4. Our Q1 interest expense is expected to be in the range of 510 to 590 million dollars. The long-term nature of our contracted revenue backlog provides us with visibility well beyond 2026. As we continue on our hypergrowth trajectory, we expect to exit 2026 with annualized run rate revenue of 17 to 19 billion, which we expect to grow to more than 30 billion of annualized run rate revenue as we exit 2027. We are not building towards this trajectory speculatively. Contracted customer demand, deep strategic partnerships, active infrastructure deployment, industry-leading capabilities, and a thoughtful approach to capital markets give us the confidence to put these numbers forward. We delivered a strong fourth quarter and full year, capping a transformative 2025. We grew our contracted revenue backlog to 66.8 billion, while meaningfully diversifying our customer base, secured more than 18 billion in debt and equity capital at progressively lower costs, and strengthened our platform through new products, services, and strategic acquisitions. We enter 2026 with 850 megawatts of active power across 43 data centers, on track to exceed 1.7 gigawatts by the year end, with every contract for our new capacity expected to begin generating revenue this year. Our 2026 investment program is fully supported by contracted demand, and as we noted, our guidance excludes the potential upside from licensing Coreweave's proprietary cloud stack, which we expect to begin contributing in 2026 and scale in the years ahead. Thank you. We look forward to your questions.
At this time, if you would like to ask a question, press star, then the number 1 on your telephone keypad. To withdraw your question, simply press star 1 again. We kindly ask that you limit yourself to 1 question for today's call. We will pause for just a moment to compile the Q&A roster. Your first question comes from the line of Keith Weiss with Morgan Stanley. Please go ahead.
Hi, this is Josh Barron for Keith, and thank you for the question. Congrats on a good quarter. You came in nicely ahead on CapEx, and it's great to hear the delivery delays resolve quicker than expected. Trying to align that with seeing the active power, which is more in line, and revenue guidance in the range, which is well below like the typical level of upside. So I was hoping you could unpack some of those dynamics. If you're moving faster, why didn't that show up in the active power and the revenue? Maybe it did. Thanks.
Thanks, Josh, for your question. As we deploy capacity, a lot of that capacity came online towards the end of the quarter, and you're going to start seeing the monetization of it in 2026. We continue to build our capacity at a rapid pace. As we talked in our prepared remarks, we will continue to deploy that capacity for 2026 throughout the year as well, including Q1. And that's the impact that you're seeing. Relative to the Q1 number, we are basically providing the guidance for the first time for 2026 and Q1 at this moment.
Okay, thank you. And really great to see the list of enterprise customers. I was hoping you could unpack what that type of contract and deal looks like from those enterprise customers. We have a great sense for what a hyperscaler mega contract looks like, but any chance you could run through size, duration, prepayment, pricing associated with those enterprise customers? Thanks.
So we don't speak to individual contracts, but what you are seeing is in an environment where there is so much intense competition for the product we deliver, which is, the most cutting edge computing infrastructure delivered through CoreWeave Cloud. The contracts largely look very similar to the hyperscale contracts in tenure. And we work with each of the individual enterprise clients as we're putting together an appropriate structure for their business model and for their clients.
Great, thank you.
Your next question comes from the line of Amit Daryanani with Evercore. Please go ahead.
Yep, thanks for taking my question. I guess my question is really around the cost of financing, especially given the 30 billion plus kind of capex number we have for the year. I'm just wondering, as you continue scaling capacity, can you sort of quantify where you estimate your blended cost of capital is? How has that really evolved over the last 12 months? And when you negotiate with these data center operators, how do they assess your credit profile? Is it really tied to your customer contracts and who they are, or is it something else? And then just on the financing side, does the NVIDIA credit support, the guarantor framework, help translate into a measurable step down in your borrowing costs, you think, in 26?
Yeah, thank you for the question or questions. Look, we've made incredible progress at the company as the company matures as a business, as we have more extensive track record of operating this infrastructure, of working with the client, delivering infrastructure. You've seen our cost of capital drop 300 basis points in the last 12 months. You've seen it drop 600 basis points over the last 2 years. We expect that will continue. It is a trend that's being driven by our business increasingly performing well with these ETL structures. When you're talking about the data centers, we added close to 2 gigawatts worth of infrastructure in 2025. And just to give scale and perspective, at the end of 2024, we had 1.3 gigawatts in our portfolio. So you've seen a material increase in our capacity to access, build, and drive data center contracts. And we're excited about that. It's an important stepping stone for us as we continue to kind of drive the business. And once again, the ability to enter into contracts with that scale of data center capacity is once again a reflection of the business maturing, the creditworthiness and scale of the business increasing. As far as the data center operators go, I can tell you what I think, right? And what I think is that data center operators are very interested in working with CoreWeave. They're looking for a diversified portfolio of tenants in their data centers. They're looking to go ahead and get exposure to a company like CoreWeave that represents so much of the AI infrastructure that's going to be ultimately delivered. And so they kind of look at us as a pure play way of really getting access to the scaling of artificial intelligence, and they want that exposure. As far as our relationship with NVIDIA in terms of accelerating our ability to get access to data centers, I think the perspective that you should take here is that obviously working with an investment grade counterparty as the offtake will have an impact on the cost of capital or the cost that is associated with the data center. Obviously, working with NVIDIA, which we do selectively, but certainly not exclusively, when we're building out our data center portfolio, will have a positive impact on the costs associated with our data center footprint.
Perfect. Thank you very much for all the insights.
Your next question comes from the line of Mark Murphy with JP Morgan. Please go ahead.
Thank you so much, and congratulations on just very, very strong bookings. Mike, some of the AI models have demonstrated a pretty gigantic leap forward in the last couple of months, and the one that's in the headlines is Claude Code. But I don't think we have seen models yet that were fully deeply trained on some of these gigantic Blackwell or GB200 or NVL data centers. Really, the stuff that CoreWeave has pioneered and mastered. I'm curious what you're hearing in the marketplace, just in terms of how those Blackwell-based models are coming along. If we end up seeing GPT-6 or any of the other ones in the next 3 to 6 months, do you think it's going to feel like a huge step forward, in their capabilities, or is it looking more like a steady evolution on the Blackwell systems?
Look, the Blackwell systems are amazing, right? They represent the next step function in computing power that allows these data scientists, these companies that are driving the models, to be able to build and scale infrastructure in a way that they just haven't been able to historically. And my expectation is, and certainly every indication from the model companies, is that the rate of increasing performance from these models, we're just getting going. Now, it is early in the deployment of Grace Blackwell, right? Like, there are not that many clusters that exist at the size and scale that we talked about we have already delivered. As those clusters come online within our portfolio, within the global portfolio, I think it stands to reason, and you will see step functions in performance that are associated with this new technology. We're really excited about it, and I think our customers are extraordinarily excited about it, because they understand what they're going to be able to do with this technology that is so incredibly performant, both from a training perspective, but also from an inference perspective when it becomes available for them.
And Mike, thank you for that. And just by extension, because you just said the word inference, how are you weighing the merits of focusing on the NVIDIA reference architecture? It's obviously very powerful for the massive training runs and some work beyond that. Just the other side would be any inclination to work with custom ASICs that they do legitimately seem to offer better inferencing price performance, and then obviously NVIDIA's acquisition of Grok maybe kind of, I don't know if you think that sort of resets the playing field in a way that staying NVIDIA reference architecture might kind of reign supreme even for inferencing. I'm just wondering how you sort of project that forward.
Yeah. So look, whenever we have these calls and whenever I'm asked about this, I kind of speak to the way that we've gone about building our business, which is we are client-led. Our clients are coming to us and they are telling us that the infrastructure that they need in order to drive their business. And I want to be clear that when they say infrastructure, it's not a training infrastructure. It's not inference infrastructure. It's AI infrastructure, right? And they're coming to us specifically because we're able to deliver such an incredibly performant configuration of the NVIDIA technology. They know we're great at it. That's why they come to us. Are they looking for other technologies from other providers? Well, that stands to reason. But what I believe is that, or what I know, is that we are unable to catch up with the demand signals that are coming in for the product that we deliver. And so we are going to focus on continuing to drive the solution that we have that is so performant and that has overwhelmed our ability and the market's ability to deliver infrastructure for the past 3 years.
Thank you very much.
Your next question comes from the line of Brent Thiel with Jefferies. Please go ahead.
Brent, we can't hear you.
Hey, good afternoon. Nitin, I had a quick question just on the guide, and just from a perspective, I know when you look at the revenue guide, you were in line, op income a little lower, and your CapEx was way higher. I guess it kind of illustrates even the guide you gave us all that some of the metrics, can really vary. I'm just curious, just in terms of how you're thinking about the guide going forward. Are some of the variables out that you've taken out from maybe what you saw in Q4? Are those variables taken out, or is your guidance changed a little bit? I know this is incredibly difficult to make an estimation, but some of the numbers were effectively kind of outside the range of what you initially gave us.
Thanks, Brent, for your question. So from a guide perspective, let me break it down by a few variables here. We talk about the CapEx numbers that is fundamentally in service of our contracted customer backlog, which we disclosed this quarter to be at $66.8 billion. And that's what is driving the investment in our platform. And when you think about the revenue ramp, we talked about that as well, that almost all of our contracts that we are backlog, which start generating revenue in this year. So that's the ramp that you are seeing. We delivered 850 megawatts of power in this fiscal year. And for the 2026, we expect to be at 1.7 gigawatts of power. When you think about margin, when all of this comes together in margins, our margin progression effectively is a result of these deliberate investments that we are making to meet the insatiable demand that we have in our platform. We talked about Q4. Q4 alone, we brought 30% of our total active power base, which naturally creates some near-term margin compression as capacity costs ramp ahead of full revenue maturity and recognition. As I mentioned in my remarks, Q1 represents the trough of what we would see in margins. And then from there on, as we scale into the capacity deployed, we will expand margins quarterly from there, returning to low double digits by Q4. We also talked a little bit about long-term trajectory of this business. Our strategy and our management philosophy has continued to be to invest in terms of customer demand with contracted backlog, which is what still continues to be the case. Over the long term, how it manifests itself in our business as it grows and normalizes, we remain confident in our ability to achieve 25 to 30% margins. The factors that give us confidence in that domain, if we look at our mature, fully ramped contracts and that portfolio, that generates contribution margins in the mid-20s. We continue to ramp up our margin-accretive products and services in our product portfolio. For instance, we had announced in Q3 that our storage revenue on our platform eclipsed $100 million in ARR. Today, we also discussed how attach rates for storage are now at 80% in our large customer base. While not included in our 2026 guidance, we see tangible long-term upside potential from further monetization of Coreweave's proprietary cloud stack to other NVIDIA cloud, enterprise, and sovereign customers. So what you're seeing in 2026 is a reflection of the acceleration of the growth in the back of our existing backlog, which continues to grow with customer demand.
Yeah, so I wanted to add a couple of things. I wanted to add a couple of things here, right? And so our margins reflect the cost of building tomorrow's revenues, right? That's what we're doing, right? As Nitin said, the fundamental margins at a stabilized facility are in the mid-20s, right? And as we continue to build our infrastructure, as there is more infrastructure online, that will come to bear. The variance that you're seeing is a function of how much infrastructure we are bringing on versus the installed capacity. We brought on 260 megawatts worth of power in Q4. It's fully a third of our installed capacity. So the variance that you're going to see there is higher. As we continue to grow and scale our company, as the incremental data center capacity that we bring on becomes relatively smaller, you will see less variance from us, right? This is what the acceleration looks like. Making the decision to go ahead and invest, to pull in tomorrow's revenue, to be able to serve our clients is a fundamental strategic decision that the company made. And we're doing this extremely responsibly because we're not doing this, we're going to build it and they're going to come. We're doing this leaning into the backlog of contracts that we have already sold.
Great. Thanks for the color.
Your next question comes from the line of Gabriela Borges with Goldman Sachs. Please go ahead.
Hey, good afternoon. Thanks for taking my question. Nitin, I wanted to ask you about the diversity of customers that you have on your platform. I'm curious if you can share with us your observations on how the unit economics or how the attractiveness of how these customers are using the Coreweave platform is different between types of customers. So a little bit of a broad question. I know that your pricing model is based on dollars per GPU and then the length of the committed contract, but curious if you could share your observations on customer behavior across the different cohorts. Thank you.
Yeah. So I think a lot of this depends upon, the variables that we've talked about in terms of how we structure our contracts. The term length, the amount of upfront payment, the generation, and the demand for that capacity at that moment all dictate into it. Fundamentally, as Mike described, our contracts look mostly similar across our customer base, with the exception, of course, the volume element that we look at, things when we are talking about larger customers versus smaller customers. But across the board in our customer profile, we look to generate similar economics for the infrastructure that we are generating as with the market dynamics go on. Mike talked about how, for hoppers, we're continuing to see incremental demand of recontracting those hoppers at about 10% of the original ASPs when they were first contracted to, A100s where the ASPs are actually increasing as we write newer contracts. Those dynamics are broader market dynamics, but across our customer base, the economics kind of look relatively similar.
Yeah, the only thing I would add.
The color.
The only thing I would add is that one of the things that I do think is very exciting is that many of the enterprise customers, many of the smaller AI native customers, they're coming onto our infrastructure and they have the ability to use the H100s and the A100s. Their ability to build product and to be able to serve inference with that infrastructure is a really wonderful sign of the depth and resiliency of the bid that is looking for compute. It's new use cases, people doing things that we've never seen before. It's really exciting.
Thank you for the thoughts.
Your next question comes from the line of Ben Reitzes with Melius Research. Please go ahead.
Hey guys, thanks a lot. I wanted to ask the other side of, I believe it was the Brent Thill question. One of the things going on in the market is there's all this CapEx and not enough margin or cash flow, necessarily in the near term. And so, I think that's what he was getting at is that, you guys were talking about your margins being 20 to 25% over the long term, but, and then your confidence to get there. What is your confidence in the rate of the CapEx growth? Like, we understand you're spending now to get the revenue, but does that growth rate moderate more than we're thinking, as those margins go up? Do you need to keep spending at this kind of upside versus the street on the CapEx side in order to hit those numbers? Just a little bit more color on the CapEx side that balances Brent's question on the margin would be really helpful in the rate of that trajectory. Thanks a lot.
Yeah. Thanks, Ben. That's a good question, right? And I think it's really important that we deconstruct that question into at least two pieces, right? The first piece is that our business is built on a success-based model where clients come to us and buy long-term contracts to get access to the infrastructure to build their business, right? And so when a hyperscaler comes to us and buys infrastructure for 5 years, they are going to be purchasing that infrastructure from us at a fixed price for 5 years. And that is a very stable way to go about building our revenue and our margins. And that's where Nitin gets the confidence around the margins from, is because we know not only what we're going to make now, but we know what we're going to make as those contracts move through the 5-year cycle that they have been put under a take or pay contract. And so that is a very stable way to go about building a business. It's a very stable way to go about getting access to the capital markets so that we're able to finance the builds, right? And that's a fundamental building block of how CoreWeave has gone about building its business really since the beginning. The second question, kind of, I think embedded in that is, what is our confidence interval that there will be a continuation of demand for computing infrastructure? And this is a great opportunity for me to talk a little bit about what we're seeing in the demand stack, because the demand stack is actually fascinating, right? Not only are we seeing the proliferation of demand across the economy, going from where it was initially really housed within the hyperscaler clouds and the foundation models. You're now seeing it kind of explode into the enterprise. You're seeing it move into sovereign. You're seeing all these new participants beginning to come in and securing the infrastructure that they need. You're also seeing a really fascinating component where it's moving from just the GPU, which was the initial wave of demand that we used to launch our company, but really now starting to move out into storage, into CPUs, into, and that is really a function of the portfolio of clients that are using our infrastructure really extending into the application layer. And so as far as the demand goes, we've got our fingers on the pulse in a way that very few companies in the world have. We're getting information fed in from across the entire economy as people are trying to get access to the infrastructure that they require. So, we're very confident in our contractual position relative to the portfolio of clients that we have. And we're very excited about the portfolio of different types of clients, and we're very excited about the different types of compute that they're using. And so it's really threefold of information, threefold of confidence around the drive towards accessing compute via CoreWeave.
And a couple of data points that I'll just add is we discussed this in our prepared remarks. For our 2026 CapEx, substantially all of it is tied to already signed customer contracts that we intend to bring online this year, and we expect to double up deployed power capacity. So that's one data point. The second data point that I want to make sure that you get is from an EBITDA margin perspective. I know you talked about where is the cash associated. The EBITDA margin perspective, we generated 57% margin this quarter. When I think about the long-term contracted customer contracts that we have and those scaled customer contracts, we talked about they are in the mid-20s from a contribution margin perspective. When you look at the EBITDA margins for those, they are in the 70% zone. So that is something that gives us confidence in terms of when our contracts scale, they generate a lot of cash for us.
Thanks, guys.
Your next question comes from the line of Brad Zelnick with Deutsche Bank. Please go ahead.
Great. Thanks so much for taking the question, and congrats on an absolutely amazing year. Just guys, as we look to Rubrin contracts ahead, are you seeing demand for similar, 5-year duration? And is there anything different about how these deals are priced, the amount of prepayment that you'd expect, or anything else? And how should we think about the ROIC on these deals versus prior generation contracts and the economics that you've outlined in your original S1? Thank you.
Yeah, so thanks. It hasn't even been a year yet, although it does feel like it. I think we got 11 months under our belt. Look, we in the written statements that we made, we talked a little bit about the fact that one of the trends that we're seeing is the extension of the contracts from an average of 4 years up to an average of 5 years. And obviously that is great for us. It's stabilizing for our business. It gives us a lot of confidence around building and scaling the infrastructure. And so that's sort of the first thing I'd highlight to you is that the clients that are coming in and using this infrastructure, they're gaining more confidence in the longevity of the usefulness of the infrastructure, which once again gets back to many of the important components that are required for us to build our business. The pricing on the infrastructure, we kind of we think about that from a margin perspective, and as the infrastructure changes in price, we are altering our pricing of how we deliver it to clients in order to kind of target the type of margins that Nitin spoke to. And so, like, those are some of the trends that you're seeing. Now, as far as prepay goes, prepayment is always a lever which we can use with clients to change the economics around a contract. One of the things that's very exciting for us is as we continue to drive down our cost of capital, our dependency on prepayments is reduced.
All right. Thank you.
Your final question comes from the line of Michael Turrin with Wells Fargo. Please go ahead.
Hey, great. Thanks very much. I appreciate you taking the question. This is for Nitin or Mike. Can you just speak to what gives you confidence in the $30 billion run rate by 2027 and how much of that is already booked versus business your team needs to go get? And maybe as a second part, just if you could speak to any change in demand you're seeing. Mike, you touched on some of the segments of the market, but just any change in demand you're seeing across those segments and how you prioritize across those as well. Thanks very much.
I'm going to do it in reverse order, if that's okay. One of the things, yeah. So one of the things that we as a business are very interested in is making sure that we have a diversified perspective on what the compute is being used for. And so, we're really out there working with everyone that consumes compute in every way that we can, because we feel like that gives us the best view on where the demand is going to come from. And I've said this before, one of the things that's going to happen here is as compute becomes more available, you're going to see businesses that don't even exist yet, ideas that don't even exist yet, have an opportunity to come into existence. Those will be new clients of ours, and we want to be able to pick them up right at the beginning as they go ahead and build these new incredible businesses. Moving on to your question around the $30 billion run rate, like what we're doing is we are taking the contracted power that we have, and we are projecting out when the existing contracts that have already been sold, and like I said, we are virtually sold out in 2026 of all of our capacity, and then continuing to add contracts that will be allocated once they come online in 2027. And we have vast and sustained interest from our clients to get more capacity to bring on more compute. And these are some of the largest, most creditworthy companies in the world. These are some of the most important AI labs in the world. These are the people that are building the AI future, and they are trying to secure infrastructure through CoreWeave. And it's really exciting. And when you move through that exercise, we have a lot of confidence in the $30 billion number that we've put out there.
Thank you.
All right. So like I said, we've got 11 months in here, and I appreciate all of you working with us as we've built this company. So as we wrap up here, I want to thank the CoreWeave team and our partners. None of these accomplishments would have been possible without you. I am incredibly proud and humbled of the execution across the organization. From product velocity and innovation to operational excellence and financial rigor. The focus and intensity across our organization is what enables us to continue our hyper-growth trajectory and the size of the incredible opportunity that lies ahead. Thank you all for joining us today. We appreciate your support, and we look forward to updating you in the future. Thank you.
Cool. What did you guys think? What are the initial takeaways? Neil, I'll start with you. You have your mic unmuted. Jose's still thinking. There's a big brain to work through and all the thoughts.
No, I mean, I'm just mind blown with all the other news that's going around right now, other than Coreweave.
Do you want to go ahead and quickly share that?
Yeah, so Netflix is not going to buy Warner Brothers. So they declined to raise the bid even further. Stock is up 10% after hours. I think it's the right move. They're also going back to repurchasing their own shares, which is exactly what we said before.
They were watching the show, Neil, and listen to your idea.
I wish that were true, because they still have not answered 3 of my emails, but okay, fine. No, actually, they did watch a video of mine, I think 2 or 3 years ago, because they sent a complaint email that I was comparing Disney's subscriptions to Netflix subscribers. They were not happy with that comparison. But anyways, that happened. I'm happy as a shareholder. Stock is up, so even better. I do have to apologize to Tanner, because it does seem like the Jack Dorsey BS is the reason why software names are down. The layoffs. So everyone's running with this idea that
he just yelled it loud enough, so everybody's is repeating it. That's what ends up happening, right?
I was like, yes. Is that the reason, or did I just I'm just convincing?
I mean, everyone on X is repeating the same thing again and again, like, oh, the Citrini or whatever the Substack is called is right, blah, blah, blah. I mean, let's be honest. And some people, even on CNBC, said, oh, this is a profitable, growing company, and this is definitely because of AI. This is not a growing company. It's a company that had grown 0.3%, okay? This is not because of AI. This is a business that had no business having 10,000 employees in 2026. I mean, Jack Dorsey, to me, is a terrible CEO, good entrepreneur, but terrible CEO. And so to frame this as, oh, we now have very intelligent tools that can do, I mean, come on. You just figured out today something that you should have figured out 3 years ago, that you have too many people doing absolutely nothing at your company, just like at Twitter. I mean, Elon came in, and the first thing he did was fire 75% of the employees there. So yeah, everybody's running with the same narrative right now, because that fits the narrative in the market that AI is going to destroy everything. But it doesn't make sense. Like, Block should not have had 10,000 employees. And again, sorry for anyone being laid off, although the package that you're getting is not a bad one. But yeah, it's not because AI is making this company such a tremendously well-run company suddenly.
Jose, curious your initial thoughts on Coreweave. And this is the second biggest position in your portfolio, if I got that correctly. And the stock is now down, even though this is light work for Coreweave investors.
It's light work for Coreweave investors.
But it's down 10%. What's
it's
the initial reaction?
I mean, overall earnings, I liked. I mean, this is one of those companies that's being aggressive with the build outs, right? So that they kind of talked about it, right? They in just one quarter, they built 30% of their capacity. So when you're doing that, it messes with the numbers dramatically, messes with the margins, and messes with everything else. And they're going to continue to build out at this scale. And I, who am a huge AI mega bull, am all for that. But obviously that comes with the risk of what happens if the demand is not there. Which I don't think is not going to not be there, right? I think it's going to continue to grow as we see this massive AI, just agentic AI going further. I like the full year guidance, right? Of I forgot what did they mention? Was it 12 billion? Something for the year? What was it? 12 to 13 billion revenue for the full year of 2026. Then they gave ARR of like 17 to 19 billion, I think it was, for this year, and then ARR for 30 billion for next year. I like more the full year revenue opposed to ARRs, because every company does ARR a little bit different. Some do it at the last month, some do it at the last 3 months. Some might do it at just the last week of what they're running. So ARR is a little bit different. So I like to look at the full year revenue. CapEx growth strong. I'm happy that they mentioned 1.7 gigawatts of active power by the end of this year. So they're going to double their capacity again. So yeah, I mean, everything seemed good. I don't think anything, obviously the debt is the scary thing, but I think it comes with, if you want to be very aggressive with this move, you're going to have to take out these crazy loans. Now, they did mention that they have about a 300 basis points on their overall financial story compared to the beginning of last year. And that on an annualized saving was about $500 million on interest, which is crazy. And as they mentioned, they believe this weighted base is going to continue to go down over time within this year. So still about $500 million, have $1 billion in interest expense, I think, for Q1 is what they guided. But that's why they have Papa Johnson, right? To give those $2-3 billion investments to make sure you can keep on moving. Just final thoughts. They mentioned collaboration with NVIDIA a lot, which I always say this is one of my favorite things about this player. And in the revenue guidance, they didn't include this software push and cloud push that they're starting to do, which they mentioned was still going to be revenue driven. It was still going to be, there was going to be revenue in 2026, but they just, I guess, can't model it right now, and it's not being included. And that's going to be both revenue growth and margin accredited. So there's upside here.
Lastly, I wanted to ask Neil, there's some people that have questions regarding Duolingo. I also got messaged by a good friend of mine who was a long-term believer in Duolingo and said that he's most likely exiting because essentially the story has changed. That the DAU growth of
price has changed.
The DAU growth of 20% was much lower than what they expected, and that it's not the amount of growth that they expected.
Yeah, I mean, I'm yet to listen to the earnings call, but it is low. The question here is, are they starting this year putting the bar extremely low in order for them to easily beat it throughout the year? Because there is also a new CFO, so I guess it fits. But I don't know. It might be 20% and they just come in at 20%. But I don't know. I'd have to listen to the call to see also the way they answer the questions and the way they speak about their goals for 2026. The growth rates are definitely coming down. The thing with this company is that they're still very profitable. The engagement rates are still increasing. Like the monthly to daily conversion sits at 40% for Duolingo, which is up from 37%. I'm sure you've seen the Fiscal AI post on X. So that things are working out for them, and yet they decided to fully pivot away from monetization. It's, I don't know, it's a very strange thing. Some people were saying it's because they are seeing that AI tools or language tools are coming out rapidly, so they already have a huge base. They rather focus on releasing new products, making sure that they attract more and more people to the platform, and then once they are saying they should reach 100 million daily active users, they could easily start to monetize those, which, to be honest, yes, just turn on advertising again and you have more users to serve ads to. So I guess that should work out. But for that to work out, the daily active user growth needs to be above 20%.
Sorry, I just came across I came across this image that's making me laugh about Google. It's search leading Waymo and DeepMind and YouTube and Cloud. And now they've all grown up, and now they're leading search home.
Indeed.
So good.
Although search is still 54 or 55% of revenue for now.
That'll do fine as well. It's one of those things where it's like a lot of the AI growth is still going to fall under the traditional category, like similar with Meta. a lot of their investments in artificial intelligence are not going to show up in some new line item called AI revenue, right? And so people are wondering what they're spending on, but yet miraculously the conversion rates and the amount of ads delivered and the user growth continues to climb. Is that all from us today? Is there any last remarks that you guys have?
And Coreweave next quarter revenue, was that a small miss? I've seen some people say there is a market was expecting 2.2 billion and they came in at 1.9 to $2 billion. So maybe that might play a part.
I did see that too. I don't know where they it's interesting to see how they model this. I guess it's just I wonder if some of the delays got pushed on a little bit more. But yeah, I did see that create a bit of negative sentiment as well.
But it's funny, right? Like the same thing was happening with Nebius. Like Nebius, it essentially came out and said they're like, none of our internal metrics have been missed, but Wall Street just doesn't know how to accurately assess this business. Is that what's happening here? That Coreweave's guidance is being hit, but Wall Street somehow expected more? Yeah.
Wall Street doesn't like to be wrong. I mean, we saw with NVIDIA, right? They were wrong with the numbers and they had to punish the stock, even though NVIDIA outperformed.
Yeah, I mean, of course, there is a big difference here, but I guess with Coreweave we are expected to grow fast, but in order to grow fast, we need to burn cash, which is a bit what they've been saying in the course. Like, we need to spend the money in order to capture all of it.
And the other thing is, it also, not realistic, it all depends on when the data center gets turned on, right? If it gets turned on in Q1, but it gets turned on in the last 2 weeks, you're not going to get much of that revenue. I wonder, I wonder, because some of these analysts that were asking questions, we're just not making sense of how, it seemed like they didn't even know how data centers worked, or kind of the components within there. But it all depends on their model. Did they expect X gigawatt to turn on in week 3 of Q1, and instead maybe Coreweave might be turning it on in week 8 of Q1? So it's like all that plays a lot with the modeling. So I do think with a company growing this quickly, and AI data centers, at least where we're at right now as a full business, is kind of a new market. So all these analysts still need time to learn how to model it correctly.
Yeah, I think it's one of those things. I saw a comment saying like they want to be the leader in this AI cloud. They see an unbelievable ability to grow here. The backlog's exploding. How are you supposed to do that on a budget? Like why do people expect them to also be not growing CapEx, but also taking on a ton of new customers, new revenue backlog? It's like, it is so weird to me that a bunch of these cloud companies that are growing in real revenues by large growth rates, like Google ended up just putting up 48% year-over-year growth, and then they also got punished for their CapEx. And it's like, well, maybe they're seeing a very clear path like they did the year before to get to this accelerated growth rate. And now they're expecting 50+% rates. And that's at Google's side. Now, at Google's size, what can Coreweave do while expanding their CapEx by nearly double year over year? By the way, 30 billion is no joke. That is, whenever you're looking at the big four, you almost need to include Coreweave and Nebius now as being like together. That's $50 billion of capital expenditures, just those two names tacked on to the big four in terms of GPU spend. And that's not clouded by any other investment, right? Like Amazon might have other investments and warehouses and stuff like this for their e-commerce business. That's GPU spend and Shell and, but yeah.
It could be that some of that CapEx though could be to go and rent out these GPUs as well. So I also think it's also a little bit careful to kind of like add them all together, because we know, right, Meta is going to go and rent out some, it's going to pay Coreweave some money. So it's like that it's not all additive for NVIDIA too. There's some overlap in there. Not much, but some.
Understood.
They did say margins should they said margins will ramp sequentially from low single digits in Q1, expanding in each Q2 and Q3, and returning to low double digits level by Q4. So exit rate of this year should already be low double digits, which is a good thing for 2027 because the 2027 revenue target is already super high. So imagine 27 with still super rapid revenue growth with higher margins. Picture should be changing quickly for CoreWeave from a
Did we just
market
see a Google and Meta deal?
Who?
Yep, I think we did. Google's up 0.9 right now. That sticks out, eh? Okay.
Google and Meta?
Yeah, I see one right here. Meta to use Google chips to develop new AI models. Information.
Funny. Doesn't that come out just 2 hours after there were some issues at Meta with their...
Yeah. What's the name of their Olympus or something?
I don't know what names
MTAI?
they're using
MTAI.
for... Olympus.
Yeah, they're I think they're having roadblocks on their chip design, and so they're slowing down talks there. But hey, this is from Honeyfingers. Thanks. What is Honeyfingers? Thank you, Paul. I appreciate that. I feel like it's a bad word. I feel like
I can't believe you said that, Tanner. I don't know what it means, but it's bad.
Thank you. Can't
So,
trust.
I would say this Meta deal with if it's true, right? A lot of rumors come out, but if it's true, I think the market always likes to punish other players. Like, is this bad for NVIDIA? This is bad for AMD? No, I just think there's just that much compute for AI right now that everybody needs to make friends with everybody and try to get as much compute as possible. I think that's how crazy this AI market is. And it's cool to see that AI CapEx was so high last year. And that's when we were still just in like that chat bot era still. Like now, in just the past month alone, we've seen agentic AI. Like, why would we think this story is even ending right now or in 2027 if we just see this getting better and better and better?
I'm curious what, like, whenever I think of generative use cases on Meta, I think of like them 1 million Xing their need for generative AI in terms of like creating images on the fly that would be on a per person basis, like very, very targeted ads. But agentic AI, I don't know what are you going to set up for, like, I don't know, maybe to help with ad campaigns for businesses, but maybe not at a consumer level. I'm just not a big believer in the Meta AI story, like the actual product Meta AI, how they say they have like 1 billion users on this thing. I honestly think it's fake. Like, I think it's people misclicking it. Like, I've misclicked it before. I don't know a single person in the world that uses Meta AI.
My grandmother misclicked it as well. She had no idea. Who am I talking to here? I'm like, this is nobody in your contact list.
Who's this Al I'm talking to?
Yeah, Meta Al.
No,
but
Jose, you had a good explanation of the AI generated content.
Yeah, like Tanner, I think it's. I don't think in the consumer world for Meta I don't see it either with that Meta AI, but with kind of AI for generative, like Meta has all your information, or if you're your Instagram user, Facebook user, Threads or whatever they have user, if they know what you like to see and what keeps you on the platform. So I know right now we're only at like 10-second videos, but imagine a year from now if video gets super cheap at 1 minute. And let's say Tanner loves to see things about fitness or Meta or something together. And it's like, we don't have a content creator that has made something like this. I can maybe generate something for $1, create this video, this 8-second, 20-second, 30-second video for Tanner, because I know he wants to watch this. I'm going to be able to keep him on this platform a lot longer. I'm going to be able to hit him with more ads. So it's just like that individual generation, like you were saying for picture, but I think just for video, for audio, Jose likes corny dad jokes. I'm going to make this quick list of corny dad jokes in audio format that Jose can now stay in this platform for an extra 20, 30 seconds. And then I know because he's going to stay here longer, he's going to stay on the app for another 15 minutes or so doom scrolling, and then I'm going to hit them with another ad within those next 15 minutes. So I think for Meta, I see it perfectly of why they're spending all this AI, but
that's
it
not
seems
even
far-fetched.
really like, dude, I completely agree with that. I 1000% subscribe to that. But I think more what I was asking is like, I would consider that generative AI. But during this boom of like the ChatGPT moment, as Jensen described it, of agentic artificial intelligence, what is that spark for Meta? Or do they not have one here? And they're still just waiting for, better picture and video at lower and lower costs?
I don't know how much business actually gets run on Meta. I actually don't have any like Meta apps. But I know Facebook Marketplace and a lot of businesses do run some form of e-commerce. I wonder if that's where, like you mentioned, it could be in the advertisement side. It could be in, hey, I need to do this for my business really quick. Can you just run it back there? I still think it's going to be, if it's in the consumer side, it's still going to be more on like entrepreneur consumers based on, opposed to just like actual average Joe using the platform.
Yeah, that's fair. That's fair. And I think that was actually one of the comments from Zuckerberg, is that they want to push more into shopping and commerce this year in 2026. That could be quite interesting.
I mean, they could turn Facebook Marketplace into a real, I don't know, eBay competitor or whatever, because everyone that's using Facebook Marketplace for some reason likes it.
Yeah, I don't know. I have a hard time selling anything that I have used before, nor do I buy anything used. Everything I buy is new. I don't want
big money.
No, not like that. I don't want to buy something that like I think might have a defect. Like, how do you know? How do you get your money back if it's wrong? If you buy directly from a store and you go, hey, this thing's broken, they're like, hey, sorry, we'll give it back. Like, we'll give you a new one. You can't do that on Facebook Marketplace, and not to my knowledge.
You can use PayPal and get your money back.
Yeah.
All right. So tomorrow is going to be another SaaS apocalypse day because Jack Dorsey decided to run his company in a more efficient way.
Also, I tweeted about that, and people think that like I agree with the sell-off. I'm not agreeing with the sell-off. I'm just saying that's why I think it happened. But I do agree with you 100%, Neil, that Jack Dorsey is not the man for the job, and he's blaming it on artificial intelligence, but really what it is just bloat. So until I see it happen from like a really, really strong business, Meta's hiring people. They're not looking to fire people. They're essentially saying that now all the software engineers have just gotten even more productive. So we can actually hire more people because they're, putting out essentially more dollars per hour.
Yeah, I hire one engineer, but it's doing the work of two engineers. So it's like
so hire 4, get 8.
Yeah, I mean, Google increased their employees by I think 9,000. What's the number year over year? Anthropic is hiring a Salesforce engineer. Funny how that works.
Yeah. And Workday is they're a customer of Workday and Salesforce, and what a weird paradigm that we live in right now. It's hard to invest in this landscape.
AI isn't real, but also AI is taking everything.
Yeah.
Yes.
I know which way you believe, Jose. You're muted.
I meant it's real. I didn't want to scream too loud. AI is going to be it's I don't know. It's just I don't know why I'm not. I am 100% in AI tech companies just because of that. And it's like, sure, some quarters might suck, but it's like nothing has shown me otherwise that this story is not going to continue.
Someone asked about SMR. SMR is down 5%. Yeah. I don't know. We didn't take a look at that one, but I am past my due date. It's already past 6:30, so I have to get going. Ladies and gentlemen, if you guys aren't following the great and powerful Neil Crossroads on YouTube and X and probably many other platforms.
Is this a new...
What is this? A new Neil? Neil Crossroads?
Oh, Couch Investor. Jeez, I'm so used to saying Roy Crossroads. Yeah. Roy actually paid me to say that so he could get more followers. Neil Couch Investor. Jeez. Jose Najarro at
Jose Najarro. Yeah, that's my community. But Jose Najarro, you can just find me at Jose Najarro everywhere.
What the chip
chip happened.
That's the overall AI community.
Yeah.
Air Canada is a terrible airline, by the way.
It is
terrible.
It is. I could have told you that.
Yeah, you should have told me this. Terrible.
I didn't know until you were here.
Yeah.
Tanner Patel. Yeah. I deserve it. Okay. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But until next time, bye for now.